Repeatedly, good news is good news, and Lisa and I were talking about it just briefly there. Until when? 425, 450, 475 on a 10-year? When does good news start to become a bit of a constraint for equities?
Well, look, I mean, I think it's what gets you to that 4.5 or 475. I mean, if we're printing 250K jobs and we're at 4.5, I think equity markets will be fine. I mean, if it's related to deficit spending and a buyer's strike or something like that, then that's bad news, to begin with. So, I'm not going to, as you know, if we're printing strong jobs data and the market's rising on that and yields are reacting, in step, then I think we're okay. If it's coming from a third-party source or something like that, then that's a different issue.
Okay, that's a very sanguine, logical view, but we've talked about the efficacy of logic in this particular market, and you have the likes of Goldman Sachs coming out and saying, actually, valuations matter. And when you start getting real yield for bonds and you start to see those type of levels, people will start to invest in bonds for total return, for capital gains, and it will be an offset to potential stock allocations. Do you ascribe to that kind of view that essentially, at a certain point, stripping out the why, stripping out the good news is good news, you're going to see some sort of penalty to stock valuations if yields go to a certain level?
I mean, no, from our perspective, I tend to live 12 months in view, and valuation isn't as big a consideration over a shorter holding period. I'm sure David and team they're obviously looking at longer dated returns. And yeah, if you're going to hold equities for 3 to 5 years, valuation matters and yields matter a little more. But look, we could have made the same argument in January. People were saying, oh, cash rates are 5%. I'm just going to sit in cash. Well, the equity market's up 20 now. So there's a logic to that, and maybe on a risk reward or Sharpe ratio basis, you would have rather been in bonds this year, though my bond colleagues tell me the volatility isn't so much fun over there either. So look, I think there's
Shots fired.
Look, their volatility is impacting me personally, so it's a little painful. But no, so I would say yes, valuation matters, but for that you're talking 3 to 5 year type period. Level of yields I think matters, but it's the why. And the fact is, if you're printing earnings growth like we're printing, then I think it's going to be hard to keep people out of U.S. equity markets.
So we were talking about sort of the wall of worry and how it seems to be escalating in the 2 weeks ahead of this election. And one wall of worry has been fueled by this idea that there have been downgrades, revisions lower to the forward look that we've seen of some companies. It doesn't seem to worry you that much. Why?
Honestly, third and fourth quarter have kind of been revised down with the historical norm. Like consensus is usually too bullish, and that number kind of drifts lower. The number that looks high relative to history would be the 2025 numbers. So I think if companies are starting to talk about 2025 and take those numbers down, that would worry us more. And I think that's where kind of the revisions risk is for the equity market. Third and fourth quarter seem like we're going to be okay, but 2025 seems a little bit bullish right now. And if companies confirm those numbers, that was a big focus on the bank side, right? People were pushing on these banks to talk to us about 2025 and NIM and what's going on there. So yeah, I'm not as worried about this quarter, but out year is definitely looks it's a high bogey right now.
Stuart, in your note, you talk about the VIX as a 1-point election premium versus market internals, which is a bit less premium than expected. Why? We're 2 weeks out.
I think people are going to kind of getting convinced with the betting odds and things like that moving in one direction that maybe gives you a little bit more confidence that one party might win versus the other. I also think, look, if you have 4 outcomes, you have Trump, Harris, and then you have the sweeps. And I think the market is starting to basically say that blue sweep is such a low probability that you kind of take one of the options out, and I think that option is generally probably viewed as a little bit negative to markets by investors. So I think sort of taking one of them out has helped. I think odds moving in Trump's favor has probably helped a little bit, and the fact is we're rallying, which I think is helping as well.
But do you think the financial markets are taking their cues from the betting markets? But this could be all the same people putting on the same trades, self-fulfilling prophecy.
I agree. Look, real clear, and some of the polling has also tightened up a little bit as well, right? Those are as tight as they've been probably since late July. To your point, yes, there's a lot of skepticism about what's driving those betting odds, whether it's predicted or Polymarket. Polymarket, I think, is viewed as a little more international, and there's no limit on the size of the wager you can put on there. So Polymarket I would take with a huge grain of salt, for that reason. But look, people believe that markets, whether it's betting markets or equity markets, is wisdom of the crowd. And if those things are moving and there's money behind it, it's not going to be ignored. Do I think people have a high degree of confidence in its predictability? I doubt that. But look, it's an input into the risk reward.
I want to talk about the wisdom of the crowds, because we talk about that as trying to understand what is the Trump trade. And when you see a rally extended, how much is that because people truly expect Donald Trump to win versus some of the fundamentals we see in the earnings, et cetera? How do you parse the two?
Look, I think we're 50-50 on the election. Like, I think if anybody believes they have a strong view on who's going to win, that's probably not the right place to be. And look, Trump. Look, the Trump trades. Obviously, banks is considered a Trump trade by a lot of investors. Banks have done well, but frankly, we also got banks earnings. So, from our perspective, I'm a fundamentals person. I think the earnings are driving that, more than the election odds. Look, this happened in early July as well. You had, a rally in Trump trades, banks included, but at that time you also had CCAR. You also had some positive news on the Basel side of things that was also driving it. So it's impossible to parse. I mean, there's no way to say the markets are pricing an X% of a Trump victory. But if you want to believe it, then you're gonna use the sort of price action in your favor, I guess.
Just a few words on the earnings. As we often say on this program, we all say you can learn something about the earnings and how the market responds to the earnings. What have we learned about how the market's responded to the incoming earnings over the last few weeks?
I mean, I think a couple of things. One, on the bank side of things, I think expectations were low. Inline was good enough, and I think we saw that play out in the banks. Banks' EPS for the quarter has been revised up about 1.5%. On the S&P side, I think what you're seeing is the bar isn't particularly high, right? I mean, the quarterly S&P number has been revised down about 1% in the last 2 weeks, and equities have done fine. So I think those two things are telling you bar was a little bit lower this time. If you put up inline numbers, it's a positive. That said, there's not a lot of macro events this week. There is a lot of earnings this week, particularly on the 24th, and that's ultimately going to be the real test for the market. How does that large cap tech print? And then to your point, how does the market actually trade that number?
You said that it was important to understand not necessarily third and fourth quarters, but what's going to happen in 2025. What will it do to earnings, or what will it do to the response in stock prices if we have no visibility into 2025? And frankly, corporate executives are saying that's a crapshoot.
Yeah, look, I think if there's a lot of uncertainty about that 2025 number, that should add risk premium into the market. And I'm not saying equities will trade lower, but it should create a little bit of more friction to the upside. If that's happening too, and look, I think the market is going to reorient it back to the economy and say, if we're not really sure about corporate earnings, then we need to look at the economic data. If the economic data is strong, we're going to translate that through into a solid sort of corporate earnings season. And if not, we're going to get a bit worried. So look, if the micro is murky, we're going to focus on the macro. But to your point, if the micro is murky, then there should be a little bit more risk premium on those stocks, and that should be a little bit of a headwind to upside.
It feels like we're in this positive virtuous cycle. Equities are high because earnings are good, spreads are tight, the outlook improves. The outlook improves, earnings are good, equities are higher, spreads are tight, and then the outlook improves. What's going to disrupt that in the coming months?
Well, this is the reason why people are talking about geopolitics, and I think that you underscored a point that after the election, regardless of who wins, there's going to be a vacuum of power, and there's going to be the potential for a whole host of different geopolitical hotspots. Look, I can raise all these worries. People are going to say, okay, nervous Nelly, what else are you worried about today? But the bottom line is, this is the reason why on the margins you are hearing people sound caution, at least on the surface, but then buy stocks.
Cheat guide. The list is always long for Bramo.
100%.
Very long. Stuart's good to see you. Thank you. Stuart Kaiser there. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Famed short seller Carson Block shared his bullish outlook for the biggest U.S. stocks on Bloomberg earlier today.
There's a Fed put. There's always a Fed put. Does there come a point in time when the system breaks and the Fed can't fix it? Theoretically, yes. In our lifetimes, I don't know. So I think for now, it probably just pays not to think too much, just close your eyes and buy, probably Mag 7.
Despite recent stimulus, the Mighty Waters Capital founder also went on to reiterate his aversion to China, a market that he's been calling uninvestable. Donald Trump's trade policies will do major damage to the economy if he's re-elected. Former New York Fed President Bill Dudley, writing for Bloomberg Opinion, saying that the former president's trade policies didn't do too much damage in his first term, but they will if he wins in November. Dudley writing, higher tariffs would raise both inflation and hurt growth. The New York Liberty have won their first WNBA championship. They beat the Minnesota Lynx 67-62 in overtime of Game 5 of the finals last night. This was the Liberty's 6th trip to the finals, losing each one, including last season. The Lynx were trying for a record 5th WNBA title, breaking a tie with the Seattle Storm and Houston Comets. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next, Donald Trump's favorite word.
If these companies don't make their cars and products here, then they will pay a tariff, a very stiff tariff, when they send their products into the United States. We're going to call this policy Build It in America Plan.
That conversation up next, live from New York City this morning. Good morning.
Is this real momentum from Wall Street?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Equities down by a third of 1%, yields a bit higher, up by 4 basis points. The 10-year 4.1243. Under surveillance this morning, Donald Trump's favorite word.
If these companies don't make their cars and products here, then they will pay a tariff, a very stiff tariff, when they send their products into the United States. We're going to call this policy Build It in America Plan. We brought the rate down, and you saw this, from close to 40% to 21%. Now we're going to get it down to 15%, but only if they build it in America.
So here's the latest. Global markets bracing for Donald Trump's plans to overhaul the U.S. economy through steep tariffs and big tax cuts, including cutting the corporate tax rate to 15%. Adam Posen of the Peterson Institute issuing a word of caution, writing, the Trump approach weaponizes uncertainty. But uncertainty is a difficult weapon to control, and it will backfire on whoever wields it too widely. Adam joins us now for more. Adam, welcome back to the program, sir. Always important to spend some time with you and think through some of these issues. Let's just talk about that quote a little bit more. What do you mean when you say it's a difficult weapon to control and will backfire on whoever wields it too widely?
Thank you, John, for having me back on surveillance. I think the issue is that you do two things that don't necessarily work in economics when you threaten a lot, but it also is harmful to you. The first is you create uncertainty not just in the minds of that corporate CEO or that particular government you're negotiating with. You create uncertainty ripple effects throughout a whole bunch of other governments, a whole bunch of other companies, and they start to self-insure. They don't just get scared to do what you want them to say. They don't necessarily do what you want them to do. The second problem of this uncertainty weaponization that Trump is big on, or at least is one way of rationalizing Trump's policies, is that you actually have to implement it to be credible. You can't just threaten it. So a lot of people talking in the markets, a lot of pundits, a lot of people even affiliated with the campaign say, well, this is all just about a negotiating position. Trump will threaten these tariffs, Trump will threaten these taxes, and that will induce the reshoring to the U.S. But you can't do that unless it's credible you're actually going to do it. And the only way to do that is to actually implement the policy. So you get the harm up front and you don't necessarily get the benefit. One of the ironies, John, for people you and I and others on this program talk about is that the more the markets bet that Trump, A, will win, but B, will not actually do these crazy things, the more it is incumbent upon him to have to do them.
But Adam, when you hear from some Trump economic advisors, what they say is that it will be used as a carrot and stick approach, meaning maybe 2.5% of the 60% they want to do on China, but 2.5% every month until they get Xi Jinping to the table. Because what they say is that there needs to be fair trade between China and the United States, and they do not view trade right now between China and the United States as fair. Do you view trade right now, what China is doing, as fair?
No, but I also don't view it as something you whine about. I mean, this is the thing that both the Biden team and the Trump team have done, is if they had been Georgia playing against Texas, you know, the top two in the football, the college football, they would have spent their whole time whining about the referees, and when a call went against them or the crowd went against them, they would have packed it up and gone home. That's what they're doing. They're packing it up and going home. But real players in the major leagues, which the U.S. economy should be, if you have to win, you win even if the referees are skewed against you, even if the crowd's rooting against you. you don't get so caught up in excuses and small deterrents.
Okay, Adam,
so
but the Biden administration kept
trade is too small. Sorry.
The Biden administration kept those tariffs on. So what would you?
Yeah.
What would be your idea for both of these campaigns to try to level the playing field?
Well, but I think the point is the Biden administration and the Trump administration kept on those tariffs, and it's had absolutely no effect. The so-called phase one tariffs on China deal, which Trump had no effect in terms of what they were buying or selling. Both the Biden and the Trump administrations claim the Chinese are still stealing IP, still subsidizing, still doing this and that. So you can say, oh, well, then if this didn't work, let's try it tenfold. But that's the key difference here, is that Trump this time is talking repeatedly on the record in the platform about doing tariffs at 10 to 20 times the level he did last time, and doing them across a whole range of countries, not just China, at a much higher level. At China, he's talking about multiple fold. And so it's going to have much worse effects on the U.S. economy. You can shrug it off. It's not good. It's a tax on people. Companies that were affected by the tariffs lost valuation, as the New York Fed study showed. It was inflationary for people. But the big thing is Harris has at least said repeatedly, Vice President Harris has at least said repeatedly, tariffs are a tax. They're a regressive tax that hurt working people more, which is full on true. And she's not going to do across-the-board tariffs. I'd still wish she, in her administration, if they're in, reconsider this whole approach. But nonetheless, there's a very big difference between stopping the tariffs where they are now and only using them in specific cases at China, which is bad but minor, versus doing across the board huge tariffs.
There's a bigger question here, Adam, and this is the reason why the whole concept of tariffs has been resonating with a lot of people, which is there are whole swaths of the U.S. economy that feel left behind by globalization, by moving manufacturing overseas, and would welcome the manufacturing and some of the industrial prowess to come back to the United States. Is there a proposal to increase production in the United States in a sustainable way with the staff that we currently have?
I think the answer, Lisa, is no. I mean, I might push back at you at that political perception because it's not really grounded in reality, but certainly there are people who are obsessed with having domestic manufacturing. And we have manufacturing. You know, you talk about Apple, you talk about NVIDIA, you talk about all these companies that are worth much, much more, as somebody tweeted this morning, than the companies that make stuff. You know, these are the companies that design stuff, that do R&D. And so then you can say, well, what about the terrible things that are happening? There aren't that many terrible things that are happening. We have the highest labor force participation rate in forever. We have one of the lowest unemployment rates in forever. We have income growth much higher than it's been. We have fewer people in poverty than it's ever been. So this constant refrain that we're losing because our manufacturing has moved up and up and up in value and become more productive and therefore needs less workers on the floor is falsehood. So then you say, okay, but how do we buy off the angry people? Well, that's how you get Trump. And that's not good. And so at some point you have to appeal to people that they maybe shouldn't be so angry, or that they maybe should adjust. And the reality is we can't drive the entire country about what's happened in a few counties and a few states. I mean, that's part of our politics, that year after year, a majority of the country clearly has views on whether it's gun control or globalization or the economy or healthcare, and it gets stymied by very small groups.
Adam, where does national security fall into this at a time where an increasing number of the goods that we're talking about could potentially have some national security components?
That's a much more serious issue, Lisa, and that's the one which is genuinely difficult and people are wrestling with. I mean, you can imagine, it seems a bit of a stretch, but you can imagine, for example, if we do buy Chinese EVs, that there would be planted bugs and controls and things in there that could be dangerous. Not clear what the economic response, however, is the way to get around it. That doesn't mean you should let everything in. But we see right now, there's news reports now about all these weapons that the Russians are using, all these things that the Chinese are using, where you can see that ASML, TSMC, all these companies that we're protecting are still selling and producing in China. So, and that's in the very narrow spectrum of focusing on just the chips and just these critical industries with the full weight of the US government and allies, and you still can't maintain the sanctions and the controls. So again, it's like the tariffs. Do you just keep upping and upping and upping it, saying, well, we didn't try hard enough?
Yeah.
Or do you rethink?
Adam, it's a tough spot. A conversation you and I will continue. We'll all continue with you through to election day and beyond. Adam Posen there, the Peterson Institute. I want to mention a data point that I think is at the heart of all of this. If you go back to 1995, China's share of global manufacturing exports, 3%. 25 years later, north of 20%. And a lot of towns, a lot of communities in the Western world left behind as that manufacturing shifted abroad. And where we're at right now is what Donald Trump ultimately displayed back in 2016, that this is how you win elections. This is how it's done. And what we've seen develop since thereafter is the spread between sound economic policy and the kind of policies that win you elections getting ever wider. So you can have conversations like this with economists. Adam can make really fantastic points on the matter. But as far as politicians are concerned, these are the policies they believe they need to convey to the electorate to win elections. And until we do something about that, then ultimately this is the path forward.
And it is the swing states that have seen a lot of these areas hollowed out and really become the main areas that determine elections for the entire country.
Up next on the program, we'll catch up with Bloomberg's Javier Blas as oil rebounds with traders tracking supply risk in the Middle East. Brent 74, WTI back in the 70s.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
Coming into Monday on the longest weekly winning streak of the year so far on the S&P 500, we just had week 6. As we open up week 7, we're negative by about 1/3 of 1% on the S&P, just a little bit softer on the Nasdaq 100, down by 0.6%. Earnings season ramping up through the week. GM and Tesla, 2 to watch.
To me, that's actually possibly the highlight of the week in an otherwise data light week, unless you consider the beige book a highlight, which I think it should be. But really, to me, a key question here about competition from China and the delta, the difference between U.S. car manufacturers and what we've seen out of Europe that have really been hammered in both expectations and sales forecasts going forward.
We've had a few analysts come on this program and point out the same thing, that we had downgrades to the outlook. South Stellantis, we heard from VW, we heard, I think, from BMW, the same story.
Same story.
Hasn't been great for others either. A GM and Ford going to follow suit with the same story.
There is an understanding, and frankly, we've seen this in recent earnings, that they have actually diverged meaningfully because they have a solid buyer base in the United States. You don't have Chinese cars coming into the United States. And frankly, their sales in China are not as big of a component as they are among European auto manufacturers. Not to mention the fact that the likes of GM have done very well with both hybrids as well as combustible engine cars and trucks, which seem to be a mainstay for Americans.
I'm thinking of Jay Pulaski and Pulaski's Tripolar World. 3 very different auto markets, and we've talked about this a few times on Bloomberg Surveillance, that this is the direction of travel. We're going to have 3 separate islands that don't really interact with one another, and auto plants in one place to produce for one, auto plants in another one to produce for another.
It seems as though in this tripolar setup, the United States is further along in terms of the isolation. Maybe it's geographic, but in terms of the supply chain as well, than, say, Europe, which hasn't come up with that framework perfectly yet for exactly how that will look.
I have a long-term question for the auto industry, which is, if the world really does move to EVs tangibly in the future, what does China do next? They have the raw materials and they have the processing, about 80 to 90% of the entire production. At what point does China say, you want an electric vehicle or you want the battery for the electric vehicle? You cannot just buy the battery, you have to buy the car.
This is what the tension could look like in the coming years. That's the equity market. Here's the bond market. 2-year yields look like this. They're up and away by 3 basis points, 3.98, just short of 4%. We're up 4 basis points on a 10-year, 4.1282. Yields the highest since July 30th of this year. So you've got to go deep into the summer to see yields this high earlier this year. A question about what's driving this. Is it the economic data or is it the politics? Is it the politics? And I think Stuart Kaiser did a decent job of this a little bit earlier from Citi. Stu said it's not so much about a red wave. It's about taking away another scenario. It's taking the scenario away that is a blue wave. People really reducing the probability that could take place, evolve, materialize in the next few weeks.
And that's the reason why he said volatility had come down and marginally, but you haven't necessarily seen the volatility go down dramatically when it comes to the bond markets, because there is this possibility, if you get a red sweep, that could potentially, under certain economic scenarios, cause the deficit to increase more, as any sweep would, and thus cause some sort of extra premium to be baked into the Treasury market.
This story of high yields in America fueling some dollar strength for a 3rd consecutive week. That is the longest weekly winning streak for the US dollar against the euro, going back to June of this year. If you look at the euro right now at 108.51, it's negative once more by 1/10 of 1%. I think this sets the stage for the IMF World Bank fall meetings this week, just how different the outlook is for America versus the rest of the world.
And exactly what is the approach that lawmakers take and policymakers take, especially as the heads of finance ministries come together? Do they talk about borrowing more money to support industries, or do they talk about the idea of fiscal restraint and the woes of the deficit of the United States and how that could cause a problem and how it's important to bring your deficit down? If they talk like that, a lot of people will be nodding their heads, but it is not necessarily a good sign for the European region, which might need more of a cash infusion than, say, fiscal restraint.
The euro at 108.51. Under surveillance this morning, Southwest Airlines and activist investor Elliott Management may finally be heading towards a truce. Sources telling us here at Bloomberg that both sides have been discussing a potential settlement that would avoid a proxy fight for control of the airline's board. Lisa, that stock is down 1.3%.
So basically, it looks like they have a stock buyback plan. They're going to going to keep the CEO. They kicked out the chairman. Either way, Southwest shares are up 7% so far this year, which would be the first annual gain going back to 2019. There is a feeling that this company has underperformed, even at a time when people have been talking about how low-cost airlines in general have been seriously challenged.
On top of this, we've seen Southwest come out and make these policy changes and these tweaks to not just revitalize the company, but also try to fend off Elliott. I have to say, at the end of the day, I think the consumer might win from this. Southwest will begin selling assigned seats late next year, introduce a premium fare option offering extra legroom. So if you want to get maybe a little bit of a cheaper airline price ticket, but not terrible service or terrible legroom, they're doing some due diligence.
Who paid for this spot?
There's a big reason that there's an activist investor on board, because everything you just said could have been said 5 years ago. They're so late to this story.
Honestly, you need to get fees. Otherwise, you're going to have a hard time. You need to become a credit card company and just sell all the extras, sell the oxygen that you have to breathe. I'm waiting for that to happen because I remember flying Frontier and they said, you know, do you want a drink? Okay, that's going to be $3. And that was a bribe for my kids.
They were about to say they were about to start selling oxygen over at Frontier.
Well, you never know.
Pretty close to it. Let's get you an update on politics. Kamala Harris saying Donald Trump's lack of decorum will disqualify him from some voters. Harris telling Reverend Al Sharpton of MSNBC, the US president's, quote, walk into rooms around the world with the earned and self-appointed authority to talk about democracy and the rule of law. He's not earned that right, and that's why he's going to lose.
She's going after some of the things he said on the campaign trail this weekend. Some of them were inappropriate. I'm not even going to repeat them. Not just about calling her out, but also former pro golfers, etc. This might not land for some people, but it could land for others. The issue is, obviously, 2 weeks to the election, they're all going to be giving it everything they have. Where are they today? Trump is going to be in North Carolina, wanting to make sure that state that notoriously goes red stays with him. And where is she? She's going to every single blue wall today. Pennsylvania, Michigan, and Wisconsin.
So we leave the golfer comments to one side. Pretty strange over the weekend. Let's get you an update. I'm not going there. An update on the Middle East.
Want to.
Hezbollah attempting to attack Prime Minister Benjamin Netanyahu's home north of Tel Aviv. No one was injured, but Netanyahu's saying it's another reason retaliation against Iran is warranted. Israel's still drilling down on plans for an assault against Iran 3 weeks after a ballistic missile attack.
So what I find interesting is that today we are going to see Secretary of State Antony Blinken going to the region. His 11th trip since the October 7th terrorist attack. Why is he going now? I really do think this is the United States making sure they get him in the region. You have Lebanese reporters talking about the fact that Amos Hochstein is also in the region in Lebanon. They want to get these U.S. officials in the region. Why? It buys them time. If you have the Secretary of State in the region, you cannot be Israel and then have a massive retaliation against Iran at the same exact time.
Part of the reason crude is up this morning by 2%, WTI $70.80. Crude rebounding after falling close to 8% last week, with traders keeping an eye on supply risk as Israel continues to weigh retaliation against Iran. Other headwinds including signs of soft landing in China as banks there cut lending rates. Bloomberg's Javier Blas joins us now for more. Javier, welcome to the program, sir. We're going to be talking about coal. We'll talk about gold as well. I want to start with oil. You wrote a number of weeks ago that the risk of falling to 50 might be greater than the risk of rallying to 100. Has your view changed, Javier?
No, it has not changed, and mathematically, and I know this is a bit of a red herring, but mathematically, with Brent and WTI trading between $70 and $75 a barrel, we are closer to 50 than we are closer to $100. I believe that Israel has put aside his initial intention to retaliate against Iranian oil installations, and therefore we have removed a chunk of the geopolitical risk. The focus is still on 2025, more OPEC crude coming into the market, soft demand growth next year, and an oversupply market that doesn't require prices close to $100 oil.
Javier, when you look at the fundamentals of this story, we have Amin Nasser basically today talking about the fact that he's bullish on China. Do you see that demand pick up in China?
Amin Nasser is a seller of oil and one of the world's largest sellers, so he also always bullish about China. I don't think that the global oil demand is as weak as some people say. We are growing still around 1 million barrels a day, and that is quite remarkable considering all the amount of electric vehicles and energy efficiency that we are introducing in the global economy. But at the end of the day, the big problem is that OPEC bringing extra barrels into the market, the non-OPEC supply led by the United States, but not alone. Brazil Brazil, Canada, Guyana, other places, more oil coming into the market. At the end of the day, this is not just a question about whether China is strong, it's also a question about supply. You could have very strong demand and very strong supply, and therefore an oversupply market. And I think that when you put all together for 2025, we are going to have more oil that we are going to consume, therefore prices will need to be a bit weaker.
Okay, but let's look at the short term again and just look at the geopolitics of what's playing out. Do you think the market right now is pricing in enough the potential for an extended or war we are seeing right now in the Gulf?
No, the market is not pricing a significant disruption in Middle East oil supply. If we were to have a significant disruption in Middle East supply, say that we were to lose all the Iranian oil supply and perhaps oil from other countries in the region, say Saudi Arabia, the United Arab Emirates, Kuwait, we will have much higher prices. The market is not there, and I don't think that the risk is as elevated as some of the bulls try to paint. But yes, I do agree that if we lose a significant chunk of oil, then prices need to go much higher. That is not price.
How much is gold a geopolitical play versus a completely separate story entirely?
To me, it's a complete separate story. The main drivers is too much public debt around the world, high fiscal deficits, with some countries running based on a GDP fiscal deficits that look more like we are fighting a war with countries that they are not fighting wars at the moment. So yes, there is an element every time that there is tension in the Middle East, there is gold, that's the safety, but I do think it's mostly a financial play, a fiscal and public debt. And the meetings this week in Washington of the International Monetary Fund and the World Bank are going to be having a big focus on public debt, and I think that that probably is positive for gold.
There's a sort of larger takeaway here where we talk about what's influencing, what's sort of the geopolitical hedge, what's sort of the idea of the supply-demand dynamic, given how much transition there has been to a number of electric vehicles in places like China. It raises the question of increased demand for what, right? How much oil are they actually going to use? What is the commodity that you look to really understand consumer appetite? You start to see it pick up, or sort of the most leverage to an increase of activity around the world. Is it still oil?
Oil still gives you a very good, clear indication of where the global economy is heading. And if you could drill down in subcomponents of oil, I would say diesel is really the key component of the global economy. That is today where the weakness is in China. There's a lot of talk about gasoline demand being weak because electric vehicles penetration in China and other places, but really the refined petroleum product that has been weaker relative to what the expectation was has been diesel, and that's manufacturing, that's construction activity, generally transportation of goods.
Javier, when you're talking about AI demand, everyone's going in for electricity, this consumption. You have a great piece out this morning talking about the fact that coal is not going away and actually is the driver of this transition. Are we at peak coal, or potentially could this even go higher?
We have been talking about peak oil since, if I remember correctly, around 2013, and it was always said that peak coal was going to be reached in the next couple of years. So in 2013, we say it was in 2015. 2015, it was 2017, and so on and so forth. And we are not there yet. Global demand for coal in 2024 is going to be at an all-time high. I believe that next year will be very similar. So we don't have yet peak. And also, the word peak to me is the wrong one. You are a mountaineer, you like a bit of trekking. When you talk about peak, you reach the summit of a mountain, and when it comes after the climb is a very rapid descent. It's just the going up and the going down is very similar. Here, when we talk about peak, is we reach the summit and we stay there on a very high altitude plateau, and that's not what a lot of the net zero by 2050 scenarios say. We need a peak followed by a rapid decline, almost a cliff. That's not happening.
How much are people looking at the AI adoption and how much that's going to really increase demand when they start looking at things like coal usage, when they start looking at what gasoline demand could look like going forward?
If you look at what the electricity consumption in the next, say, 7 years, 6 years from now until 2030 is coming from, AI is going to be playing a role alongside data centers, but it's very similar in terms of size for what we know today to the incremental need for desalination of water. The biggest drivers of electricity demand in the next, to the end of this decade, to 2030, are going to be coming from the industry, where the industry continues to electrify, moving away from natural gas and petroleum into electricity. It's going to be coming onto electric vehicles, and the other big chunk is going to be on air conditioning. The needs for cooling, the needs for air conditioning in the world are absolutely skyrocketing. And that's a combination of climate change, hotter weather, but it's also a combination that a lot of the population in countries where the summers are really hot are getting wealthier, and they're reaching the GDP per capita that is traditionally associated with the first purchase of an air conditioning unit. And that is what is happening across large swatches of North Africa, Southwest Asia, places like Pakistan, India, etc., etc. And that's where the electricity is going to be coming in. Artificial intelligence, yes, I'm just trying to be nice to artificial intelligence. It's the kind of sexy new thing in the energy transition, but it is not the thing. Desalination is going to be as important. Very few people talking about that part of the electricity consumption.
Interesting. Javier, this was just a brilliant piece. Enjoyed reading it. Javier Blas there of Bloomberg Opinion. You can find that column on Bloomberg.com and on the Bloomberg terminal. Here's a few paragraphs that jumped out for me. The International Energy Agency published its annual World Energy Outlook. Buried in the 398-page report was a warning, and here's the quote. The outlook for coal has been revised upwards, particularly for the coming decade, principally as a result of updated electricity demand projections, notably from China and in India. And here's the number for you. It wasn't a small revision. Javier writes, coal consumption in 2030 is now estimated to be 6% higher than only a year ago.
So how is that transition to clean energy going? This is the quintessential dirty energy source, and yet this is sort of one of the necessary components to adapting to a very new world.
This is why there's tons of criticism on the clean energy transition, especially looking at these cheap EVs coming out of China. That actual EV may be better for the planet, but how it got to be made, these negative externalities on the transition. You know what else I thought of when Javier's talking about not this peak, but this plateau? Remember in the debate when Donald Trump went after Germany and how they had to revive, quote unquote, normal energy? Germany came back with a response, but their response in itself actually proved Trump's point. Germany said, I just pulled it up, coal will be off the grid by 2038 at the latest. 2038, that was their response.
It's the dirty secret in the energy transition. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Goldman Sachs says the S&P 500's decade of big gains is about to come to an end. David Kostin and team said that the U.S. stocks are unlikely to sustain their above-average performance and that investors will turn to other assets like bonds for better returns. Kostin predicts the S&P 500 will post an annualized nominal total return of just 3% over the next 10 years. That compares with 13% in the last decade and a long-term average of 11%. Boeing shares higher in the pre-market trade, up 3%. It reached a tentative deal with its largest union to bump employee pay by 35% over 4 years. Workers vote on Wednesday to end the 5-week strike. That happens also to be the same day of Boeing's third quarter earnings, and it will be CEO Kelly Ortberg's first. However, hourly workers have yet to sign off on the agreement. Union negotiators are not endorsing the proposal. The Kansas City Chiefs are the NFL's last undefeated team after taking down the 49ers in overtime in a rematch of last year's Super Bowl. The game saw no touchdown passes and 5 combined interceptions between Pat Mahomes and Brock Purdy. Elsewhere, the woes are deepening for the Jets after falling to the Pittsburgh Steelers on Sunday night. Donald Trump was among those in attendance, making a campaign stop and leading some fans in a USA chant. And that's your brief, John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the U.S. in the driver's seat.
The world's savings have gone to the United States. What we are now is, I think, the market completely wrong-footed by the U.S. economy.
That conversation up next.
think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
So, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry. And
crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Stocks just a little bit softer. We're down 1/3% on the S&P 500. Under surveillance this morning, the U.S. in the driver's seat.
The capital inflows from everybody sucked in by U.S. yield, by U.S. tech stocks, by U.S. exceptionalism, U.S. outperformance overall over the last couple of years. So, the world's savings have gone to the United States. I think we have to clean out some of the positioning at some point and get a more meaningful dollar sell-off before the U.S. economic outperformance can drive us lower. What we are now is, I think, the market completely wrong-footed by the U.S. economy.
The US dollar on the longest winning weekly run since June. Terry Wiseman of Macquarie suggesting recent strength has two pillars, American exceptionalism and the Trump trade. The first has been attested to in more hawkish US data, stronger activity, less disinflation versus the rest of the world. The second found its support in Donald Trump's rising probability of winning the US election. So long as they persist, the dollar can strengthen. Terry joins us now for more. Terry, good morning.
Good morning, John.
So that's the big if at the end there. Can they persist? Which one is more durable?
Well, we don't know who's going to win this election. And I think regardless of who wins this election, American exceptionalism will continue at least a little longer, in the data certainly. There is a catch, though, and the catch is, what if we have an election? And forget about who wins for a moment, but that election is contested, and people start to question American institutions, specifically election and political institutions, and legal institutions as well, because we know there'll be a lot of lawfare involved in any contesting of the result of this election. That's where we might start to get fragility in the American exceptionalism story, and that's how the American exceptionalism story is linked to the election. But until then, they're really two separate issues, and they can run independently. Clearly, if Trump wins and we don't have a contested election, then we'll have a Trump trade, and we'll have American exceptionalism running at the same time. That's the better scenario for the dollar, obviously.
Just how much upside could there be in that scenario?
Well, our own projections have the euro-dollar FX rate going down to 105 if Trump wins. We have dollar yuan in China going up to 740. It's clearly a strong dollar story that continues from these levels if Trump wins.
So you're talking about a contested election. At the same time, people are talking about election week, not necessarily election day, or perhaps election 2 weeks or 3. At what point does it become a problem for the dollar? At what point, as it grinds on, as ballots are counted and people kind of try to determine and recount again?
Yeah, so if you go back to the 2020 election, I believe that there were some states that had not resolved their final counts for 4 days or 5 days. Now, that didn't mean that we didn't know who was going to win, because maybe those states didn't matter in view of the counts that we got from other states that were deterministic in favor of President Joe Biden.
But I think that's a good benchmark, right? If we have a situation where states that happen to be decisive for the election are going on beyond 3 or 4 days, then I think we start to see fragility in this market.
If there's a contested election, do people buy the dollar and U.S. Treasuries because they need a safe place to go, or they're viewing the United States as not on fair footing, as a scary place potentially to invest, and they buy other things? Like, is that reason why maybe gold is higher?
It certainly is one of the reasons why gold is higher. I think people are trying to hedge the political uncertainty out there to some extent. And it's not just the U.S., but it's international as well. But getting back to the U.S., yes, they would buy treasuries because that is the obvious safe haven. However, I don't think that would be good for the dollar, right? I think in this context, it would be lower yields, but a weaker dollar as well. And those are completely consistent with one another if you think about it.
Terry, the one I'd worry about, and Lisa, I'm sure you feel the same way, if we wake up that morning and treasuries sell off and the dollar does too, then we've got a problem, a big problem.
That speaks to a question of really what the underpinnings of the country is, and really goes to Terry's point about American exceptionalism and how much that gets undermined in a serious way.
Terry, it was great to see you.
My pleasure,
as always,
John.
plenty to think about. Thank you, sir. Terry Wiseman there of Macquarie. In the third hour of Bloomberg Surveillance, we'll catch up with Jim Karen of Morgan Stanley, Jason Gursky of Citi, Aditya Bharve of Bank of America, and we'll speak to Bob Elliott of Unlimited Funds. 15 days to go until Election Day, or as Lisa suggested, Election Week. Kicking off just around the corner. Equity futures on the S&P 500, just a little bit softer from New York City. This is Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are 3 fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number 2, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number 3, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. The top names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything. The countdown is on. Everything you need to get Get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Financial conditions are incredibly loose.
The market in fixed income is definitely volatile.
Equity volatility, for the most part, has been low.
It can look a certain way at the index level, but there's opportunity under the surface.
I don't feel bearish by any stretch, but valuations feel full.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Election day, 15 days away. Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now with equities pulling back from all-time highs on the S&P 500. The 47th record high of the year in Friday's session. We're down 1/3% on the S&P this Monday morning. We're down 0.6 on the NASDAQ 100. Looking forward to a week full of earnings. The focus of our attention on the automakers in America. Tesla and GM just around the corner.
How much visibility do they have into the future at a time where you do see this increasing fissure, particularly in the European auto manufacturers? I'm also wondering, and I know this sounds like it's really peripheral, but how much they see an increase in demand because benchmark rates are going down. This is the type of sector that could get a bit of a boost from some of the interest rate cuts we've seen so far.
I'm glad you started this hour with its 15 days to the U.S. presidential election. Citigroup comes out today, waiting for two risks. No, honestly, we're going to get earnings and stuff, but really we're waiting for two risks. And they say limited data out this week will keep markets focused on the two risks, the U.S. election and the upcoming jobs report. In the meantime, jobless claims and PMI will be the focus this week. But really, we heard from Neela Richardson. She's talking about the fact that it's a boring economy and there is hesitancy on the side. Why? Because people want to know the outcome of the U.S. presidential election before they start maybe moving jobs, investing more, getting M&A deals done. The list goes on.
Get that week ahead up on the screen again, because I think it all speaks to each other. The auto earnings later on this week, potentially speaking to a divide of weakness over in Europe and strength in the United States of America, a divide that the IMF World Bank full meetings will have to address. The election 15 days away, the policies that we could see implemented in the next 6 months in this country could really shake up that industry and those economies in a much bigger way.
In a way, they are the epicenter of a whole host of different things that we've been talking about, whether it's the tripolar world, as you were talking about, in terms of isolated industries that are growing up in their own, national security and questions about where some of the chips that are an increasing component of cars are, and then to the prowess of manufacturing. And as Adam Posa was saying, that has become, in some ways, one of the biggest political deciding factors at a time where a lot of the swing states tend to really be manufacturing hubs, or at least used to be once upon a time.
Every time we've gone down to these meetings, we've had this conversation. Their ability to retain, and in some places regain relevancy in this conversation. The IMF and World Bank, they've lost the fight. They've lost the conversation. They've lost the battle. It is just taken as done that these tariffs are going nowhere. They're going to stay on or increase. And there's not much they can say this week that's going to change that.
This used to be a celebration of globalization. We are seeing the deconstruction of at least the concept of globalization in its heyday. And you have to wonder where these meetings, where the IMF, where the World Bank will sit with this. Do they castigate the United States for a deficit? Do they say that that's going to lead to higher borrowing costs? Do they encourage some sort of spending in a place like Europe? How do they sort of uphold some sort of order that they once had at a time where ultimately a lot of the politics coming down the pike are really going to undermine some of what they ascribe to?
Lisa heading down to the nation's capital a little bit later this week. Fantastic lineup of conversations coming up for you. We'll share them with you in the next few days. Equity futures on the S&P, a little bit softer here. We're down by 1/3%. The opening bell about 1 hour and 26 minutes away. In the bond market, yields grinding higher. We're up by 5 basis points now, 413.22. It's not just about the economic data. We've had a range of conversations already this morning suggesting that there is a Trump trade starting to emerge in this market. market over the last week. You see it in equities to some extent, though I would suggest it's difficult to disentangle that away from what we've seen from, say, bank earnings. You see it in the bond market to some extent, though I would also say it's difficult to disentangle that from the strong data we've had in the last week. But certainly the bond market is one way of catching that story.
Especially because Stuart Kaiser, I want to pick up on something that he said, that there is one scenario that is increasingly being priced out, looking more remote, which is the idea of a blue sweep. And as that becomes less realistic, you start to expect, well, on the margins, can't you imagine that yields would rise? And that's the reason why, on some level, people are saying maybe that's a component of what we're seeing in the bond market.
Mike Wilson this morning, Morgan Stanley, markets appear to be rotating towards the Trump win scenario. We're seeing that as well in the betting market, although there's lots of speculation. There's this whale like there was during when Romney was running, a huge whale in that betting market. One thing I will say to those that are discounting a blue sweep is what happened to the red wave that wasn't in 2022? Have people just forgotten?
In the midterms.
In the midterms.
Yields are up this morning, 5 basis points. The 10-year 4.13, the 2-year up 4 basis points, just short of 4% this morning. Coming up this hour, Jim Carron of Morgan Stanley with the S&P on the longest weekly winning streak of the year so far. Jason Gursky of Citi on why defense stocks are well positioned for growth. And Aditya Bhave at Bank of America on the case for re-acceleration. We begin this hour with stocks trading near record highs and investors consider the prospect of a so-called no landing. Jim Carron of Morgan Stanley saying he's not bearish, but skeptical, writing this: inflation is creeping higher and puts further scrutiny on the Fed's ability to cut interest rates. Tensions in the Middle East also create a potential for a more systemic type of risk. We can't forget that a bull in a candy shop is still just a bull, and bulls can be unpredictable. Jim joins us now for more. Jim, welcome to the program. Let's run with that analogy. A bull run, if you will. A bull in a candy shop. Do you think we're a little too high on sugar right now?
I think that's a good way to put it. I do think of it as a little bit of a sugar high. My concern is that we're pulling forward 2025 earnings right now, and we're painting an almost near perfect picture going into the future. It's not that I'm bearish. It's not that I'm negative on the markets broadly. I just think that we're getting a lot happening really, really quickly. In other words, we're getting this soft landing that everybody's been projecting, but we're getting it very, very fast. Valuations reflect that, right? So if you look at $280 earnings, let's say for 2025, which is roughly consensus, you assign a 21 or a 22 multiple to that, you're going to get an S&P somewhere close to around 6,000, and that's about where we are today. But if you take that valuation down a little bit and you get it a little bit more normalized to say maybe a 20 PE on those $280 earnings, then the S&P is 5,600, right? So it's lower than where it is today. It's not a disaster, but net, we're talking about a few percentage points in either direction. I don't necessarily think that we're going to be in a very strong bull run from these levels or from these valuations. So that's where my skepticism is. I'm not saying that things aren't okay, consumer strong, retail sales was good, inflation, earnings, GDI numbers are all good. So incomes are good so people can keep spending. What I'm saying is, how much can it continue at this rate of change?
Well, let's take the valuation piece of it, Jim. This is what Cameron Dawson of New Edge said over the weekend. You could have argued at any point over the last year that stocks were expensive. I'm sure you'd agree with that. But there needs to be a catalyst to change this march to ever higher multiples. It feels like, Jim, we're in this virtuous cycle right now, looking for a disruptor to it. And Torsten Slock of Apollo spoke to the same thing. The Fed's cutting rates. They've got a bias to cut even more. So we've got a dovish Fed. We've got high stocks and high home prices. Public and private financing is wide open, as you can see. Continued support from fiscal plans. Low debt servicing costs that are locked in for both corporates and households as well, Jim. That's just feeding on itself. So the outlook just keeps on improving. Now, Jim, from your perspective, do you have anything in mind that could disrupt that process at the moment? Because that's the reasons people are so bullish right now.
Yeah, and I agree with those reasons, and it's why we maintain a bullish tilt in our portfolios as well. Moving more towards neutrals, not moving towards negative, because we do think that there are some potential factors. Clearly tensions in the Middle East, a flare up there. We could get some election uncertainty or some election volatility around this. But ultimately, what we would need to see is damage done to the consumer and a rise in the unemployment rate. So I think some of the damage that could come is that if we start to see see some weakening of the labor market. Now, we're not seeing signs of that yet, but we all know that the non-farm payroll data has been heavily revised over time. And if we do start to see that in a period where we start to see some margins starting to shrink across corporate America, that could create a significant or a faster move higher in the unemployment rate, and that would completely change the narrative. We're not there yet, Jonathan, and I think that's the most important thing to highlight. We're not there yet, but we do have to recognize that at these valuations and at these levels, that it makes it hard to have a positive surprise, and it makes it easier to have a negative surprise.
One aspect of your argument is essentially kind of abnegating this idea of a cyclical tilt, that you can get that rotation away from big tech and some of the large behemoth, other large stocks, and really fuel this next leg of recovery. And I saw the same kind of sentiment from Mislav Matejka over at JP Morgan. How much are you leaning against the cyclical move, the idea that the equal weight and the Russell 2000 have been outperforming?
No, actually, Lisa, I mean, I think it's a great question. And actually, we're embracing the broadening of the markets and the cyclicals and even the defensives. So what the markets are kind of realizing right now is that this Mag 7, the tech and the larger cap and the growth names that are out there have done a very, very good job this year, but there may be more to the story, and this is going to be across the Russell, this is going to be across the broader base sectors of the markets, this is going to be across the equal weight. One of the themes that we're putting forward as we move into 2025 is, how do you invest in what seems to be a fully valued market? You can't really play the beta. You can't just say, oh, well, the index is going to go up another X%. More or less what you have to do is you have to start thinking about the different components of the markets. You have to find sectors in the markets that are well valued, that have lower PE multiples, good balance sheets, good factors, good interest coverage ratios, and have some pricing power and some controls. And you can find them in the other 493 stocks. And I think that's the stuff that we should be looking at. Those are the sectors, that's the management style that we need to start to move into, because I think it's going to be more about asset selection and investment selection as we move into 2025, as opposed to just a target weight asset allocation into X% equities or X% bonds. It's really going to matter how the constituency of your portfolio is made up, what sectors, where, and what valuations.
Is this a sort of 1 year time frame of an adjustment and investment cycle, or do you see this as a 10-year kind of time frame, as maybe the overall index level returns don't look as great as they have traditionally?
Yeah, I think this is something that probably adjusts over the next year or so. So let me call that short term. I don't think that we're always going to have this bifurcated market like we do today. I think there needs to be some coalescing, and that's where you get the broadening of the markets, where you get other sectors that haven't participated in the rally start to participate late. That's usually a late cycle thing to start to see, and then the markets tend to move in a more uniform way, beta up, beta down. So I don't see this necessarily as a long-term view, but I do say that 2025 will be all about tacticals. Don't forget, we're going to be talking about taxes and policy no matter who the next president is. We're going to start talking about that on January of 2025, because that's when the decisions are going to start to get made that are going to have big influences on markets going into late 25 and into 26, when policies are likely to change.
Jim, do you believe right now that the market is rotating into the Trump trade?
Yeah, I think it is. And I think it was said, nicely by Lisa, earlier on the show, that it's in some degree, it's a movement away from the blue wave, right? So I know we've been talking about tariffs, and we call tariffs a tax, but taxes are also a tax too, right? So if one candidate is talking about tariffs and another candidate is talking about higher taxes, they're both a tax. What does that mean to me as an investor? Inflation. And ultimately, no matter who the next president is, I think it's going to be really hard to get inflation under control. And that's one of the reasons why I think you see yields starting to move higher. It's not so much just a Trump trade or not, but I think it's a realization that we're moving to an area where deficits are still going to be high. There's still a large degree of spending that's out there, and the U.S. deficit is too high, by the way. And all of this is putting upward pressure on rates. And I think this is something that we're going to have to deal with as we move into the next months ahead.
370, September 18th. on a 10-year when the Fed cut 50 basis points, 370 this morning, 413. Jim, it's good to see you. As always, thank you, sir. Jim Curran there of Morgan Stanley, a 40 basis point plus move on a 10-year since the Fed started cutting.
This comes with people expecting fewer rate cuts, with better expected data, and we have seen that out of earnings. We've seen that out of headline data. But it's also coming with this realization that regardless of who wins, deficits are going to be a bigger question mark hanging over this bond market.
Bond yields up 5 basis points this morning on a US 10-year, 413.42. With an update on stories elsewhere this morning, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Israel launched a military operation targeting Hezbollah's economic strongholds in Lebanon. The Israeli military sought to hit targets associated with the Al-Qaeda Hassan Association, which serves as Hezbollah's alternative banking system. A senior Israeli intelligence official said that the aim is to target Hezbollah's ability to function during the current war and later as it seeks to rebuild and rearm. Elon Musk's super PAC will give away $1 million a day until the election to someone who signs a petition calling for free speech and the right to bear arms. Musk said in a post on X, his pro-Trump group called America PAC will randomly pick a registered voter in swing states to win the prize through November 5th. Pennsylvania Governor Josh Shapiro questioned the legality of the cash payments on NBC's Meet the Press, calling it deeply concerning. The U.S. Grand Prix belongs to Charles Leclerc after the Ferrari driver clinched his third F1 race of the season. The Monaco native finished the race 1-2 ahead of his teammate Carlos Sainz, but attention quickly turned to rivals Lando Norris and Max Verstappen, who were locked in a controversial finish. Norris was penalized 5 seconds for leaving the track to pass Verstappen. Verstappen ended up taking third place. And that's your brief, John.
Danny, thanks for that. Ferrari 1-2. For anyone who missed that, we'll give you a recap again in about 30 minutes' time. We won't. I might.
Okay. Is this the new thing?
What's that?
More than even football?
I squeezed that in at the end of the program.
I know, but I'm just asking.
We
is Formula
front-loaded
One?
baseball.
Oh, we're doing baseball again.
Okay, I know, but I'm just wondering, is Formula One superseding football in Fairyland?
No, when Ferrari win, yes.
Okay, duly noted.
Up next on the program, the Morning Calls Plus. Jason Gursky of Citi on why defense stocks are positioned for long-term success. That conversation up next.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
The opening about 1 hour and 12 minutes away. Stocks a little bit lower, down about 1/3 of 1%. The one to watch here, bond yields up 5 basis points. The 10-year 413.61. Time now for some morning calls. First up, Citi, downgrading Kering to neutral, noting lengthy and costly turnarounds for luxury brands. Their stock is down 1.5%. Your second call from Barclays downgrading UPS to underweight, flagging long-term pressures from the possible loss of Amazon volumes and competition from FedEx. We're down almost 2% in early trading. And finally, JP Morgan downgrading Hertz to underweight, citing a long path towards normalized earnings. That name is down 4% in the pre-market. Turning to defense, the Citi Equity Research Team saying rising government spending is positioning the sector for success, writing this: we expect spending growth to favor investments in the tools of deterrence and in the restocking of the munitions used in Ukraine and the Middle East, both of which suggest the growth of weapons spending is likely to be faster than overall military expenditures across the Western world in the near to medium term. I'm pleased to say that joining us now is Jason Gursky of Citi. Jason, welcome to the program, sir. I know you've got three different scenarios for spending, and maybe we should start there. Could you go through each of them for us?
Yeah, sure. And the scenarios are all kind of related to defense spending as a percentage of GDP amongst Western allies in particular. Our base case is that the recent increase in spending as a percentage of GDP as a result of the conflicts in Ukraine and the Middle East, we consolidate those and we continue to spend out into the future at current levels of GDP, which sets up the industry or military budgets to rise, roughly in the low single digits with this shift to military spending that you mentioned in your shift to weapons spending that you mentioned in your setup there, allowing for mid-single digit growth. The upside scenario would be, an unforeseen conflict that pops up, or the sense that Western allies feel even further threatened than they do today, and we end up spending more. And then the downside scenario would be a compression of spending as a percentage of GDP, as again, kind of in your earlier setup here, that deficits get in the way, and we need to make some hard choices on what we end up spending scarce resources on. But at this point, our base case is GDP spending as a percentage of GDP remains relatively flat given the threat environment, and that we see mid-single-digit growth for the weapons buying accounts, which supports the defense contractors.
Jason, do you have a sense of who potentially would want to add when it comes to the defense budget, a Kamala Harris administration or a Donald Trump 2.0?
Yeah, look, at the end of the day, spending tends to be driven by the threat environment. Western allies spend when they feel threatened. I think what we might see is maybe a little bit of a shift in the mix of spending between the two administrations. Former President Trump has been pretty vocal about his desire to wind down the conflict in Ukraine in pretty short order. The last time he was in that seat at the White House, he shifted spending towards things that fly and float to support a perceived threat out of the Asia-Pacific region and China. So I think we could see maybe a little bit of downward pressure on things that crawl on the ground or support ground conflict in Ukraine, and more upward spending on things that would support conflict in the Asia-Pacific. Whereas Harris, I think, would be a little bit more even-handed and spread spending across both regions.
Jason, what strikes me about this conversation that's so interesting is modern warfare looks sort of similar to what I think of when I think of previous warfare, crawling on the ground, flying and floating. How different are some of the equipment demands that you see now for modern warfare versus, say, 10 years ago?
Yeah, they are different, for sure. They're supporting troops on the ground, but space-based assets have become incredibly important. Space is the ultimate high ground. We can garner lots of intelligence, surveillance, and reconnaissance kinds of data from space, and that's why we've seen companies like SpaceX be so successful in the launch environment, and the Space Development Agency spend a lot of money on developing new space-based assets. So space has certainly been a change here over the last 10 or 15 years. And then attritable aircraft and UAVs have certainly popped up as something that is pretty profound change in the way the war is conducted today. So we're likely to see a lot more investments in UAVs and attritable aircraft. And we've got DoD standing up an initiative called Replicator to do just that.
How much of an upper hand does the U.S. have versus, say, Europe when it comes to some of this military expenditure and creation in some of the companies that are coming out?
Yeah, it's a good question. Prior to the Ukrainian conflict breaking out, I think our report suggests that about 60% of the military kit that the Europeans purchased actually came from U.S. suppliers. Today, it's about 80%. So the industrial base here in the United States is much bigger, much more diverse in its capability sets, and much healthier than what we've got in Europe. Mario Draghi over in Europe recently penned a report suggesting, hey, we've got to fix this over in Europe. We've got to have a better industrial base, and we need to be better coordinated. So that's probably going to be one of the interesting lessons that comes out of this, and maybe the long-term implications is that maybe Europe becomes a little bit better coordinated and stops importing as much as they do from the United States.
Jason, what I heard from a few individuals who surround the former president is that he would come into office and actually, you know, he talked about a 2% target, definite floor for NATO. Now he's talking about NATO allies spending potentially, one thing they will do is 3% of their GDP towards defense. How much bigger can Europe continue to spend on the U.S. defense industrial base if it's the former president in office?
Yeah, that's a good question. I mean, you certainly you get down to hard choices to do that. I mean, let's first get to 2 amongst NATO countries. I mean, NATO as a whole is already there because that includes the United States. But if you're counting just the European countries, I still think we're a smidge below 2. So let's get to 2 first. But it would be a very significant increase and lead to budgets that are 8 to 10% higher for quite a few years, you know, maybe out through the end of the decade in order to be able to get to 3% growth. Look, I think the Trump administration would continue to put pressure on the Europeans to pay their own way relative to the United States as we go to focus on Asia. It would be a big deal. It's probably a little bit harder to do in practice that quickly, given the tough choices that you would need to make either by raising taxes or cutting spending in other areas.
Jason, we've got to leave it there. It was good to catch up. Thank you, sir. Jason Gursky there of Citi. Up next on the program, Aditya Bharve of Bank of America, Bob Elliott of Unlimited from a beautiful New York City, 80 degrees in New York today.
It feels illegal.
80.
You love it, don't you?
Absolutely love it.
Yourself.
Can't get enough of it.
I know.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Counting you down to the opening bout with equity futures just a little bit softer as they have been throughout this morning so far. We're down on the S&P 500 by, let's call it 0.25%. On the Nasdaq 100, negative by almost 0.5. 1 hour away from that cash open. Let's get you some morning movers with Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. Boeing's had 5 weeks of pain and a cash burn of $1.3 billion. Looks like there's a third bite at the settlement cherry on the table. It will be put to the unions on Wednesday at the same time as the results to come through. So if this does get voted through, it looks like the next question for Kelly Opberg, the CEO, is what are you going to do? How are you going to restructure this company? The existential questions about what parts of the business within Boeing remain, and how quickly can you get 737 MAX, 767 and 777 back on the production line to help your cash burn. Let's roll it over, stick with the airlines. Spirit Airlines has been given a lifeline, so to speak. They've got about $1 billion worth of debt maturing 2025 and 2026. Stock up 36% because they've been given an extension. Extend and pretend, one could say. You've got until December the 23rd to restructure your debt, and it's one of those sort of rinky-dinks that they're talking about. The U.S. Bank National Association, it's a restructuring which may lean into the loyalty programs to help them get through. Let's just close it off with a quick look at Humana. The stock was down 42% on the year. Cigna are back at the table again. They want to try and put a merger together. Putting these two companies together would create a beast. $125 billion worth of market cap, and indeed it would let these two health insurers bulk up and fight back at the pressure on the margins in the business. Bid this morning by 4.8%. Jonathan, good morning.
Manus Cranny, good morning to you. You've been missed. Welcome back. It's good to see you back. I want to pick up on Spirit just briefly. Spirit, JetBlue. The deal that never was. Imagine if we'd been able to make that deal. I would love a conversation with the administration about what's happened here. We're not going to let this deal happen, and then this one happens.
Basically, are you going to lose more jobs because you essentially have a company that will not last if it continues by itself? And that's something that people are going to have to deal with. At what point are mergers and acquisitions something that makes financial sense for companies and for jobs? And at what point does it really become counterproductive for capitalism?
Spirit had a lifeline. They were potentially going to get the cash injection they needed, and this FTC said no because of competition issues. It's a great question, Jonathan, and it's something that would be a fascinating conversation with Pete Buttigieg.
That stock is up in early trading. Elsewhere, investors waiting for fresh economic data this week, looking for further signs of economic strength. Aditya Bharve of Bank of America writing the following: with the latest string of upside data surprises, client concerns have shifted from recession to re-acceleration. In our view, the economy is resilient, but there are enough minor headwinds to make re-acceleration unlikely. Aditya joins us now for more. Aditya, good to see you.
Thanks for having me.
So you don't believe in this re-acceleration story. So let's start there. What underpins that view?
Not yet. So we don't believe in re-acceleration yet. Let's talk about the recent data flow. Start with jobs. Obviously, fantastic jobs report for September, right? But we would think of that more like a mediocre student who aced one test. So good job. But we're not there yet in terms of, have you turned the corner, or is this really an A-plus labor market? I don't think it is just yet, right? And then if you think about the GDP, GDI revisions, the revisions were actually more to the older data, right, from early 2023, late 2022. So it's telling us a story more of a very resilient economy that's been holding on to around 3% growth in private domestic demand for 6 quarters. So it's not so much that we're re-accelerating, it's just that we've been growing well above what we thought trend was for an extended period of time.
What would change your mind? What would convince you?
So a couple of things could do it, right? The first one would be significant fiscal stimulus, but potentially after the election, but that would have to be over and above just extending the tax cuts, right? Because the tax cuts are status quo from the perspective of consumers and businesses right now. And then the other possibility is that you get a large negative supply shock. The economy is already running at potential. So with that negative supply shock, you could potentially overheat.
What is that negative supply shock? Is that sort of code for something?
Well, it could be a number of things, right? It could be geopolitics. It could be some significant disruption in terms of tariffs. Those are a few potential examples.
So you talk about the R word. It used to be recession.
Yep.
Now it's reacceleration.
Yes.
And I love this because it sort of puts into cold relief the idea that maybe this market sees the tail risk as increasingly a reacceleration and not recession. Is that what you're seeing in some of the baseline data and some of the baseline analysis that you see coming out of Wall Street?
So the way we would talk about it is that 2-3 weeks ago, before we got the jobs report and the data revisions, we would have thought the risks to our outlook were slightly skewed to the downside, so more towards recession than reacceleration. Now we think the risks are pretty balanced. But the base case for us is still an economy that just softens up a little bit, doesn't go into recession, not even close, as inflation continues to move back down towards target.
Putting this all together, what are you expecting on November 7th from the Fed?
We're expecting a 25 basis point rate cut. We are comfortable with that view. Basically, the last jobs report did the work of 2 jobs reports, right? In terms of really delivering job growth. Then you had the upside revisions as well. You really had everything you wanted. So I think they'll be comfortable doing another 25, but they don't really have to do a 50 anymore.
But what if we get a really good jobs report before that Fed meeting? Is there a chance they don't cut?
The bar would be very, very high for that for a few reasons, right? If you don't cut in November, you're basically admitting that you made a mistake in September by going 50. And you've already told us that, look, we can keep cutting for now with policy rates growth close to 5%, as long as inflation continues to move back towards target. The last inflation print wasn't great, but it wasn't terrible either, so they should be comfortable still cutting for now.
So given the fact that essentially you're saying it's not that the economy is reaccelerating, but we're staying around a level that seems like it's above trend growth, how much are you saying that maybe we need to reassess how far the Fed can cut? You know, that sort of the target rate has to be substantially higher than we thought maybe 2 months ago.
So this is exactly the question that I think everyone's wrestling with, right? So that there could be a few reasons why the target rate has gone up. The first one would be that inflation's just not behaving the way we want it to behave, right? But that would be more of an overheating story. The other potential story is that trend growth has gone up, right? That could be because of labor supply, but it could also be because of productivity. So the other thing that's happening on November 7th, by the way, which is a little bit wonkish, is that at 8:30 we get the revised productivity data, which will include the GDP revisions, right? Nobody's paying attention to that because of the Fed and the election.
Correct.
But I think it'll actually be quite interesting because the story around productivity could change quite a lot, and that has significant implications for long-term growth as well as the terminal rate.
How much do you push back against people who say you can already see the trickle effects of the 50 basis point rate cut through the economy? You can already see mortgage rates coming down and bringing more people in. You could already see loan activity picking up on the margins. Do you reject that, or do you actually say, yes, in a way, on the margins, it has been stimulative?
To the extent that that's happening, it's got to be very, very marginal, right? I mean, they cut rates in the middle of September. We have some of the September data, right? We don't have any of the October data right now, so we really wouldn't see it in any meaningful way in the data right now.
Aditya, always good to catch up with you, sir. Aditya Bhaver there of Bank of America. Distracted around the table just a little bit with news out of Disney. So check out Disney in the pre-market. This is what the stock is doing at the moment, just slightly positive. James Gorman of Morgan Stanley taking on a closer role at the company. The director in charge of planning for a successor to Bob Iger will become the chairman in early 2025, January 2nd to be precise. The executive chairman currently of Morgan Stanley, of course, that particular position, that term for that ends at the end of this year, and he's not going to take much for break, Bramo. He's going to take on the chairman role over at the Walt Disney Company. As for the CEO, we were waiting for an announcement. Succession. Give us the plan. Well, we've got a date. We expect to make an announcement in early 2026 to find out the replacement to Bob Iger.
So essentially, Bob Iger gets to stay at the helm of this company for another year. But James Gorman, what I love is that when he was retiring from Morgan Stanley, he was talking about he doesn't know what the next thing for him is and that maybe he'll take more time. This is sort of more time is to head over to Disney.
Well, he's busy doing other things. The Walt Disney Company right now, the pre-market positive by about 1/10%. We'll recap the details of that for you in just a moment. Looking ahead to a week full of economic data, plenty more Fed speak as well. But the one to watch is the next few weeks after that. When we get a payrolls report in a few Fridays' time, then the week after that, the US election in America, 2 days after November 5th, you've got a November 7th Federal Reserve interest rate decision. With us around the table, Bob Elliott of Unlimited. Bob, it's good to see you.
Good to see you.
Show. Let's get straight to it. In the bond market, yields are higher. Tell us the why. Why do you think this is happening? Why are we up by close to 50 basis points on a 10-year since this Fed cut rates by 50 basis points?
I think it's the perfect instantiation of the over-easy monetary policy that the Fed is pursuing. I mean, it is very unusual for a Fed to engage in aggressive cutting in an environment where we see real GDP growing at 3.5%, where we see the GDP gap basically at its highest level in several decades. And we see asset prices as strong as they've been, spreads low. That is not the type of economy that typically would get significant easing ahead. But the Fed is committed and the direction is clear, as Chairman Powell has said.
The bias is to cut interest rates. And that goes into an election where we could see even more debt issuance. When you start to think about where yields could go, we've got numbers on the Bloomberg today, people talking up 5 all over again at T. Rowe Price. Where do you think that yield is going right now?
Well, I think when you think about what's going on with bond yields, the key risk for rising bond yields is that you start to flow through to hitting stocks, right? Because bonds are in the stocks, whether you like it or not, and that discount rate both affects stocks directly and then, of course, starts to tighten economic conditions. And so moves in this range, we could probably withstand another 30, 40 basis points of 10 years moving higher before we start to run into some concerns that that's going to create a drag on the economy. And you're starting to see a little bit, mortgage refis have come down, mortgage activity down a little bit as mortgage rates have raised on the long end. And so, get a little bit more, 40, 50 basis points, that's when we start to get the concern. But there's a long way between where we are right now and getting up to those levels.
What are you pointing to as evidence that what we're seeing from the Federal Reserve with additional rate cuts is accommodation and not just normalization?
Well, I think the basic question is, what is neutral policy right now? And the Fed will give lots of different quantitative examples of and various models about what neutral is. But I like to look at neutral as an empirical question. And empirically, if the economy's been growing at 2 or 3% for the last 8 quarters, and inflation is above what their mandate is, and unemployment's at 4%, give or take, that's a pretty good economy at today's level of rates, and it's been a pretty good economy while these rates have been at these levels for an extended period of time. So I'd argue, at least in a time frame that anyone cares about, basically rates at these levels are neutral, not rates that are considerably lower.
If that's the case, do you actually see the potential for inflation coming back as a more serious concern? Is there a way that you're playing that through how you're positioning?
Yeah, I mean, if you look at the situation, we could have one of two paths. The first path is that the markets start to recognize this over-easy policy and start to price that in and actually get ahead of the actual economic conditions. And that's mostly what we've seen. Gold's up relative to bonds. Stocks are up relative to bonds. That's all indicative of the markets catching the Fed and saying too easy a path ahead relative to how strong this economy is. Otherwise, we'll have to wait quite a while before the actual stimulation at today's levels happens. We get a tightening of the economy, we get wage growth, and then finally we get inflation. But much more likely, we're going to see the markets get ahead of that, and that's exactly what we're seeing.
I loved your tweet last week. Gold and stocks greater than bonds. How much higher could we see gold? Because it feels like every day lately it's been a new fresh record.
Yeah, well, I think gold, the key thing to remember on gold is gold is a global asset. And so often we're here sitting in the U.S. thinking about gold relative to U.S. rates or U.S. real rates. But the vast majority of demand for physical gold is coming from China. And the direction of travel in terms of Chinese policy making is pretty clear right now, which is easier policy ahead, including what they announced in the last day or so. And so given that circumstance, you're going to continue to see a lot of demand for gold out of Asia as folks are looking for safe havens, right? It's not in their housing market. The stock market is, a bit of a casino. if you're really trying to, preserve wealth in the Chinese context, gold is the way to go. And it's no wonder that what we're seeing is easing out of China today, which is then having a knock-on effect of raising global bond yields and raising gold prices at the same time.
Mohammed Al-Aaron has a column today in the Financial Times talking about how the West needs to pay more attention to what's going on in gold, because it's not just about a hedge or geopolitics. It's actually the fact that there might be de-dollarization. This is what happens when you have things like sanctions and tariffs. Does that mean that basically 2025, 2026, gold is just a place that we'll see more and more of these central banks dive into?
Yeah, I mean, obviously the central bank demand for gold has been very strong, particularly from those countries that are antagonistic to U.S. interests. I think the main thing to recognize with gold is we've got a $50 trillion global government bond market, and just a 1% move out of those bonds and into gold would be a huge pressure on gold to go higher, because it's just very hard to create supply in the market, right? In gold, the way that you get incremental supply into the market when there's monetary demand is you have to scrap, because essentially all the demand for monetary gold that's being produced right now is already being met. So you got to figure out ways to scrap gold, and getting that, how do you get people to put cash for gold, respond to cash for gold ads on the television? Prices have got to go a lot higher to get that to happen.
I love that. Who are those catering to? Honestly, whenever I see that, I think, okay, what's the demographic?
Doomsayers.
Yeah, well, and also a certain age group. But I am curious, going forward, about how you view sort of the connection between yields and oil prices. I mean, a lot of the relationships have gotten a little bit skewed. And one thing that we keep talking about is that as oil prices go up, bond yields go up. Do you think that that's part of it, or do you really think it's entirely this macro story speaking to Fed?
Well, I think if we look over the last couple of weeks since the Fed laid out their over-easy policy, oil's traded choppily flat, and we've gotten this bond yield move. And so I don't think oil is primarily the driver. I think the big risk here, though, is that it wouldn't take much in terms of constrained supply in the oil market to create a spike in prices. And that is the worst case scenario for the Fed. Imagine, we're standing December 1st. We have a new administration that's very focused on tariffs. We have oil prices that are rising due to global conflict, and we have a strong economy. And that's going to be a real challenge for the Fed to navigate as they enter 2025.
Bob, this was great. It's good to see you. Thank you, sir, for breaking things down. Bob Elliott of Unlimited on the outlook for the next few months. The outlook for November, that first week of November. If we get a red sweep, certainly not a base case right now for many of you I know, and not guaranteed, nothing is. But if we get one, let's do some scenario analysis. We said on this program earlier on this morning, you could envision quite easily yields moving 50 basis points. What would interest me that morning and the morning afterwards for the next several days? Are yields climbing because growth is going to be stronger, inflation might be hotter, the Federal Reserve has to maybe reconsider cutting and consider hiking, or are we getting a legitimate buyer's strike in the Treasury market accompanied with a sell-off in the FX market on the US dollar? We didn't see that when yields started to climb higher over the last few years in this country. It was typically accompanied with a stronger FX market, a stronger US dollar. If you get something different, and we got a little taster of that in the UK, where gilts sold off and the pound got weaker, if you get a little bit of that in America, all bets are off.
Well, Terry Wiseman was talking about that would be basically the shift and the undermining of American exceptionalism if you get a dollar sell-off in tandem with higher yields. It's sort of the equivalent rhyme with a Liz Truss moment, and that is one of the big concerns.
Yields up this morning, 5 basis points, 413.22. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. As you mentioned, changes are coming to the C-suite at Disney. Shares have changed this morning with the company named Morgan Stanley Executive Chairman James Gorman as the chairman of its board, effective January 2nd. He's currently the chair of Disney's board succession planning committee, which is working to identify the next CEO. Disney planning to appoint that new CEO in early 2026 to take the reins from current chief Bob Iger. Elliott Investment Management and Southwest Airlines may be heading towards a truce. According to people familiar with the matter, the two are discussing a potential settlement that would avoid a proxy fight for control of the airline's board. Elliott has proposed a framework that would give it representation, but not control of the board. The talks haven't been finalized and could fall through, according to the people familiar. And Anne-Marie promised Give a baseball update. So this is for you, Anne-Marie. The LA Dodgers are heading back to the World Series after eliminating the Mets in Game 6 last night. They'll be facing their longtime cross-country rivals, the New York Yankees, who are back in the Fall Classic for the first time since 2009. It'll be a battle of the league's top superstars, with Shohei Ohtani and Mookie Betts gearing up for LA, and Aaron Judge and Juan Soto representing the Pinstripes. And tough luck for those looking for a bargain on ticket prices. As of this morning, there are 0 tickets available for under $1,000 for games in either city. And that's your brief, John.
That's not a shocker to me at all. Danny, thank you. Outfit change around the table once again.
This is going to be such an expensive World Series. I thought you said you were coming with me.
No, not now. It's a midweek game. I'm a weekend guy only. I can't do this job at
This is why
game.
I'm upset with the Mets.
100%.
One, I really wanted the Mets to win. I really needed the Mets to win so that the Dodgers and the Mets, whoever the Yankees were up against, we exhausted them before that game. But then also, if the Mets won, we could have all went to the game. Me and you, Lisa,
Yankees
Friday
would have
night.
a home game at the weekend, but that's not how this plays out. Lisa doesn't want to talk about this, so
I think that
we're not going to talk about
we should talk about bond yields. I think we should talk about auctions and the beige book.
Talk about Boeing next. Bond yields, auctions,
Yankees.
beige book, sprinkle of Yankees at the end. Up next, we'll set you up for the week ahead. The Trading Diary, just around the corner.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Welcome to the world of decentralized finance.
With the surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people,
This is a political attack, and we must hold our elected officials accountable.
the transactions,
Really a record-breaking moment.
Bitcoin is the exit strategy.
and the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond. Equities down just a touch. We're negative by 0.2%. Bond yields higher by 5 basis points, 413.42. As we count you down to the opening bell, here's the trading diary, the calendar, the week ahead. The IMF full meeting begins today. Tuesday, results from GM. Wednesday, Tesla and Boeing report. Thursday,
Another round of jobless claims and PMI data, plus more earnings from UPS and American Airlines. And on Friday, durable goods and UMich consumer sentiment. As we look ahead to Boeing, the stakes high for earnings as union workers also vote Wednesday about whether to accept the plane maker's latest offer and end a 5-week-long strike. The stock is up by 3.4%. Joining us now, George Ferguson of Bloomberg Intelligence. George, it's a decent offer. Walk us through that offer and whether we can close a deal.
Sure. So I think the biggest point of the offer is Boeing's come back to about a 35% increase in wages, which seems pretty good, although a little bit shy of some of the 10% gains we've seen for organized labor in the marketplace. I think they've sweetened some of the 401k. They've talked, I think, about more matching, I think up to 12% matching. They've talked about providing, like, I think a $5,000 incentive into the 401k. But, you know, those are numbers I've kind of looked at this morning, you know, quickly. So some of them may not be perfect, but I think you get the point, and that is they're trying to go back at the 401k, which is, it's been a challenge because the unions said that they wanted a pension, a return to the pension, which is really very difficult, again, for U.S. corporations. We haven't seen anybody roll back towards a pension ever, I think. And I think going ahead and trying to sweeten some of that increase in pay, but like I said, I think still a little bit short from what we've seen in the marketplace. So it'll be interesting to see how the whole you know, this proposal goes down on Wednesday.
Just 30 seconds, George. How much can this company provide guidance without certainty about whether they will get a ratified deal?
You're not going to get any guidance. I think you're not going to get any guidance. They're not going to be ratified by the end of the day. You'll get nothing.
George, appreciate the update, sir. George Ferguson there of Bloomberg Intelligence. Setting the bar pretty low for Boeing earnings in a couple of days.
Just to consider this. It costs them an estimated $100 million per week that this strike goes on. This is 33,000 people. How do they provide guidance when they're basically hemorrhaging cash and they don't know when they can get things back online? So the key question is, how low is that bar for them to actually walk over at a time where there is this much uncertainty?
You think 35% gets it done? Feels like it might.
I mean, I don't understand what the holdup was, because it was sort of this long-term parameter of what the future looks like, and that has to do with pensions. I don't know what kind of nod they got from the White House, because that was part of the discussions. A lot of question marks around this, especially without the union leader.
Market. Coming up tomorrow, we'll catch up with Cameron Dawson of New Edge Wealth. We'll speak to Torsten Slok of Apollo, the RBC CEO. Dave Mackay is going to join us on this program, and we'll speak to Gilles Moek of AXA. From New York City this morning, good morning to you all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Good Monday morning, 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Bassick.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And the good times may be over. Goldman Sachs is out with the warning that the S&P 500 is not likely to sustain their performance of the past decade.
Plus, Boeing union workers hammer out a tentative agreement with the plane maker ahead of earnings. The vote not until Wednesday.
And we'll take a look at surge and activist activity as Starboard reportedly takes a stake in Kenvue. All of that and more coming up, but let's take a look at markets 30 minutes until the bells ring. A little bit lower pre-market, but remember the S&P 500, the NASDAQ 100 closed out on 6 weeks straight of gains last week. So taking a little bit of a breather this morning, down a touch on the S&P, down a little bit more on the NASDAQ 100. All the while, that sell-off in the bond market reigniting, Matt. You can see the 10-year yield higher by about 5 basis points, now at 4.13.
All right, a couple of calls out today. Goldman Sachs says people are going to start buying other things than stocks. And you can see here from this chart, corporate spreads are at tights that we've only seen a few times over the past couple of decades. Meanwhile, Matthew Hornbach at Morgan Stanley says the bond market treasuries are well positioned to deal with a red sweep in November.
Stock and bond markets both dealing with valuation issues, Matt. Let's take a look at some stocks to watch under the hood for now. Boeing, as you were talking about, 3.5% higher. The plane maker reached a tentative deal with the union, and the agreement raises pay by 35% over 4 years. Of course, that vote, though, is on Wednesday. We'll talk more about it. Also watching Spirit, just soaring, 36% pre-market. The U.S. National Bank Association agreed to extend a deadline for the carrier to potentially refinance 2025 bonds. We'll talk about that as well. And Disney names Morgan Stanley Executive Chairman James Gorman as chairman of its board, effective January 2nd. The reason it matters, Disney says it will announce a new CEO in 2026, Matt.
All right, we have a couple of really big calls out driving the market this morning, or at least driving discussion around the market. Goldman Sachs' David Kostin saying that after 13% annualized returns in the past 10 years, we're only going to see 3% annualized returns in the next 10 years from stocks, which could at some points even be lower than inflation.
Really incredibly bearish if you take a look at the rest of the sell side community. It's interesting. The report is over 30 pages long. I'm working my way through all of it. I don't see a recession call in here. There's no necessarily specific catalyst here. And I mean, 3% annualized over the past 10 years. When is the last time we saw that?
Well, consider the reasons why also. And to your point here, no real catalyst, more like a slow bleed. He puts a 72% probability of it trailing bonds and almost a third of a probability here that it doesn't even break inflation of 2.2% break-even inflation through 2034. So long-term call here we're looking at.
All right, let's get to Moneta Chief Investment Officer Ethan Devitt. She joins us to talk about this and a number of other issues after we hit, Ethan, a 47th record high for stocks on Friday. I mean, the gains are really outpacing strategists' forecasts. And is that part of this call, you think, David Kostin and Goldman Sachs worried that we're just pulling returns forward from the next decade?
That's exactly my take on this particular report, and most of it relates to technology. We've been speaking about that tremendous concentration in equity markets and how so much of that related to whether it's the top 7, top 5, and how little related to the remaining hundreds of stocks that were really not making much headway. If we now return to that being the norm, that would very much translate into his forecast. I think it is a little bearish in terms of where I see the future in terms of I don't think everything has been priced into the tech stocks yet. There's quite a bit to play for there. And remember, those stocks that we're trailing, I don't think that equally, I think that's been overlooked for some time. So there's probably a little bit of pent-up demand in that. So I wouldn't be completely as bearish as that, but I do think it's exactly as you said, it's pulling forward.
So a bit bearish to your read. Let's sit on this call a little bit longer because I do think it's interesting that David Kostin, he actually raised his year-end target on October 4th, and his target over the next 12 months for the S&P 500 is 6,300. That's about an 11% gain from here. So his idea is that we're going to have a good next 12 months and then maybe, of course, like Sonali said, a slow bleed here. When you think about, of course, the trajectory that this market could take, does that sound realistic to you?
It does, but then again, we have to remember we have a pivotal electoral event coming up in a few weeks, and that could well have quite a bifurcated outcome. And we've been reading about the various hedges on either side of the potential outcome, and the fact that it could be, whereas it could generally be good for all stocks in that the economy is in robust and rude health, and we have seen that there is pent-up demand on the sidelines, and any wobble in markets doesn't last very long. However, the outcome could look quite different. We could have different outcomes for financials. Certainly, most earnings could do well if the tax situation changes, but equally some of the renewable energy stocks, some of the stocks more akin to more of the Biden economics, for example, or relating to the Inflation Reduction Act, they could come under pressure. So quite a bit of bifurcation possible. Overall, as long as employment numbers stay strong and the consumer buoyancy remains intact, I do see an ongoing strong bid for equities at the moment.
It's interesting at the moment and over the next few months are really easy to latch onto, particularly given the election. But I think one issue behind this long-term thinking here, if you think that the S&P 500 is not going to deliver you as much, why invest at these levels even?
It's a question of better relative to what, in the sense that your colleague earlier mentioned that people are going to start looking other than stocks. They actually have been looking at places other than stocks for some time. We saw quite a bit of demand for cash, for bonds. This was all while the bonds were quite interesting. Stocks are always there, though, as the engine of growth. And the reason that we see this piling in as soon as there's some kind of a correction is because there really is no other way to get these levels of growth into the portfolio. So quite a bit of demand there for stocks, but where else would they go? We've seen real assets really pick up, alternatives, the steady state income, which you talked about the spreads being very tight on bonds, corporate bonds. Because spreads are that tight and we see the base rate coming down, we don't see that being as meaningful because inflation will still be there, albeit much reduced, eroding those returns. So we do need to stick with stocks. We need to have diversified exposure in stocks and also look at some of those alternatives.
Does it have to be diversified? Carson Block, he's famous for his shorts, but was saying in terms of the average investor, close your eyes and buy the Mag 7 stocks.
Yeah, that would, I would say, quite a difficult thing to argue for the average private wealth client. We'd like them to be diversified. We like them to be long-term. That kind of volatility, and we forget sometimes just how much stock volatility these Mag 7 have shown. We've seen 10% falls in one day. It definitely takes a strong stomach. We prefer to see a steady
Yeah, but even imagine if they did it 10 years ago or 40. I was just looking at a Data Trek note this morning.
That guy is good.
Which was quoting another paper. I think the guy was Henrik Bessembinder, which is a strange name, and that's why I remember a paper from 2023 where he said literally all of the positive stock market returns from 1990 to 2020 are down to 2.4% of the stocks. So it's basically technology innovation that drives all of the expansion of the market.
This isn't the game of shoulda, woulda, coulda, which we try not to play too much because what we always know is buying into markets is one thing to get that timing right. To exit at the right time, there's another question of timing. We don't believe that we have that skill set to do that repeatedly on and over again. So we still prefer the diversified approach, recognizing that some themes, though, can be played. We've seen a lot of interest in AI-focused funds, themes, focused around digital assets and much of some of the picks and shovels, the infrastructure behind this. So that doesn't say we can't play themes. We just don't want that to be the only way we play equities.
All right, yeah, it's easy to be the CIO of Hindsight Capital, but you're the CIO of Moneta. So let's talk a little bit more about big tech, because you think about what happened last week. Of course, ASML really sending worries throughout the sector and throughout the market about AI demand. And as we think about the next year and the next 10 years, to be frank, I mean, where do you think we are on the AI investing hype versus reality cycle?
It's interesting. We're starting to have some reckoning right now. We've seen that in just some of the latest stats we've seen coming out of the chip makers, that there is a sense that has some of this, we talked about demand being brought forward. Has that been brought forward? We don't know yet where the demand will settle when it comes to AI, and there's just a lot to play for. We don't know the use cases and the implication of much of this so far. So I'd say there is still a tremendous amount of hype, and that will continue because we know that's where corporate spending is likely to go. But in terms of who the ultimate winners and losers are going to be, it is too early to tell that right now. So we'd say there's going to be more volatility, as I mentioned, in these stocks as the momentum moves around.
You think about what might come to market, not only the existing supply of stocks you could invest in that bet on AI, but also the ones that might be around the corner. You look at what's in the private markets, right? You think about the report over the weekend of Perplexity. AI could triple its valuation here in private markets. Is there a frustration at all from public market investors that perhaps the best gains are still to be had outside of the stock market? By the time they get to the stock market, how much can they grow from there?
I wouldn't say I'm experiencing that kind of frustration. I do see this point, and I think this is only underscoring just the abundance of opportunity here. Most individual investors do not have access to the venture funds that are getting exposure to this private side of the market. We do have increasing accessibility and better vehicles, but that really is out of bounds at the moment. There is still there's a little bit of FOMO relating to that, but I would say most are more than satisfied with the results they've seen in the public markets. They don't need to necessarily get a piece of every pie, but it is important to watch that because we are looking very much at how that first mover advantage can get eroded, and looking at the private market and where gains are being made there, that's where the erosion may factor in. The recent OpenAI fundraise, clearly that did give some opportunities to individual investors to get in a piece of the action if there was a co-investment opportunity being offered. So there are certainly some opportunities, but I'd say public markets are a safer place to stay given the variability of the outcome for some of these operators.
All right, Ethan, got to leave it there. Really appreciate you kicking off the week with us. That is Moneta Chief Investment Officer, Ethan Devitt. And guys, just to marinate again in this cost and call a little bit longer, that basically are going to get 3% nominal returns over the next 10 years. To me, this is really a call for cash because, again, he's not necessarily predicting a recession here. Yields are going to be high enough for bonds to compete. That doesn't imply that the Fed is going to cut rates back to zero. And in that environment, cash looks pretty good.
You know, something I'm wondering about, he makes that case for bonds as well. And it's been such an ugly trade for bond investors. Let's be honest. You have a call from T. Rowe saying that the 10-year yield is going to go to 5%.
Yeah.
If you believe that,
yeah, that's an outlier. It's important to point out that that is an outlier call from T. Rowe Price.
That's
right?
fair enough. But what if we get
as
there?
I was saying, Morgan Stanley today coming out and saying, Matthew Hornbach there saying that bonds are well positioned to deal with even a red sweep. So even if Trump wins and the Republicans take the Congress and the Senate, he still thinks we're going to do better than we did in 2016 when the yields rose 50 basis points in 6 months.
Well, we'll have to see. We know that the bond market really has been the epicenter of volatility, even relative to the stock market. And speaking of the stock market, let's take a quick check on futures. Lower today after 6 straight weeks of gains on the S&P 500, on the NASDAQ 100. You train your eyes on the small caps. The Russell 2000 currently are outperformer, but not by much, and still down about 0.1%. Meanwhile, let's take a look under the hood now. Take a look at what stocks are moving with Abigail Doolittle.
One stock dragging on the future, specifically the S&P 500 and the NASDAQ 100. Tesla, after gaining more than 1% last week, giving those gains back right now, down about 1.4%. Lots of chatter are out there on robo-taxi and what its outcome could be, both positive and negative. And plus, Tesla does report on Wednesday, so shares a little bit lower ahead of that event. We have the airlines, the last time I looked, also lower, broadly lower. There is some news on Southwest Airlines that Southwest Airlines and Elliott are going to try to work together as opposed to being any fierce proxy battle. Oil higher by about 2% or so. That could certainly be a macro drag. And then finally, to the upside, Boeing, it is trading higher, up 3.6%. They, of course, have reached tentative deal with their union, which starts with a 35% pay hike. Investors relieved. And Shanali, very importantly, this is in some ways one of new CEO Kelly Ortberg's his first moves. They report this week. We'll be getting more of a flavor then.
Wednesday is certainly a big day for Boeing. Abby, thank you so very much. And coming up, we're going to bring you more on Boeing, what to expect from that vote on Wednesday, and earnings, of course, as well. This is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
So a number of people, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Let's get out of high interest and look at what's making headlines around the world. Israeli Prime Minister Benjamin Netanyahu met with top aides over the weekend to discuss retaliation against Iran. This comes after a Hezbollah drone penetrated Israel's air defenses on Saturday and exploded next to Netanyahu's private residence. The U.S. is also investigating a leak of classified documents assessing Israel's plans to attack Iran, according to reports. More efforts to stimulate the Chinese economy. The country's banks cut benchmark lending rates. It's the latest move in a series of measures to revive growth and halt the slump in the housing market. The 25 basis point cuts were bigger than the 20 points expected by economists surveyed by Bloomberg. And Elon Musk's super PAC is pledging to give away $1 million a day until the election to someone who signs a petition calling for free speech and the right to bear arms. In a post on X, Musk said his group will pick a random registered voter in swing states to win the prize through November 5th. Katie?
All right, here's a stock that we're watching. Boeing and its biggest union workers have hammered out an accord that includes a wage increase of 35% over 4 years. It's tentative now. A ratification vote is set for this Wednesday, the same day as the company's earnings. Let's, of course, bring in now Benedict Campbell, our global editorial leader in aviation, for the details and break this down for us. Of course, we're approaching Kelly Ortberg's first earnings report as CEO, and this is a tough time. What does this mean for the different interlocking issues that Boeing has?
Yeah, so Wednesday suddenly turned into a very busy day for everyone involved. Kelly Ortberg will come out with the earnings. That's first. They come out early before the market opens in the US. And then sort of throughout the day, the voting starts by the workers in the Seattle area, which means essentially Ortberg will release the numbers with kind of one arm tied behind his back because he won't know what the result is. And that's really the one big outcome that everyone is looking at. And so it'll be in the evening in Seattle by the time that we find out whether indeed workers agree with his latest proposal. As you said, it's tentative, or whether, again, they turn it down and the strike continues and we go back to square one. Sort of the anecdotal evidence, if you look on some of the Reddit forums and if you hear some of the work of voices, it seems there's broader agreement to go along with this. They have to get 50% plus one to get this over the hump. So there seems to be a little bit more optimism out there, and certainly if you look at the market and the market reaction, there's a lot of investor optimism that this is the offer that gets them over that line.
The other thing that's underneath the surface here is the fact that they might seek a mega capital raise as well. What does all of this uncertainty mean for their ability to court investors?
So the investor side is obviously looking at this very closely. We saw from the rating agencies that they are considering cutting Boeing's rating to junk. They're just one level above the junk rating at the moment. Boeing went to investors over the last couple of weeks and came out with a sort of tentative plan last week. They filed to register for a possible capital increase to the tune of something like $25 billion in stock and equity. So it wouldn't all be equity. But that's sort of the size that we're talking about to write this company. They would do that over the next 3 years. And the fact that they got that registered means that they've won themselves a little bit of breathing room here, a bit of breathing space to get these next steps into shape. That includes the strike. That includes getting production back up. Because one thing that the strike has done, it's really disrupted the production. And that's the first thing I'll need to get back up.
Benny, we thank you so very much for your reporting. That is Bloomberg's Benedict Campbell. Stick with us. We're going to talk about the markets and the shorts behind it. Not looking so good these days. Stick with us. This is Bloomberg.
Countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
The Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
From the beating heart of global finance, economics, and politics,
and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
There's a debate as to what really drives, when you talk about the U.S. market, especially the S&P 500 or the Mag 7. I'm in the camp that, although I don't have the facility with math to really try to prove this out, but I'm in the camp that believes that what drives that index are flows. And so at the end of every month, U.S. workers, a lot of them, their paychecks go into their 401ks, which are retirement funds, and there's a robo bid for the stock. You reduce the effective supply of stock because you're taking out the active owners of stocks that will decide, hey, at this price I'm a seller, at a lower price I'm a buyer, and you're replacing that with a holder that will never sell unless and until it has outflows because people are drawing down their retirement accounts. According to that view, as long as the labor market is reasonably strong in the U.S., which it is, you're not going to see outflows. You're just going to continue to see inflows, especially in those, in the most heavily weighted names in the S&P 500.
And that, of course, was Carson Block of Muddy Waters making some really interesting points, and what an embarrassment of riches we have on this Monday, because you have, of course, David Kostin on one side saying the next 10 years, basically a lost decade. Then you have Carson Block saying, don't worry about it. You have all of these 401ks just passively buying your big tech stocks. Why worry? Why not just invest alongside them?
It's certainly the BlackRock way of thinking. You have supply that comes down in the market in terms of the number of publicly traded stocks, but you have people still investing in the market, and therefore those stocks go up. Of course, since the 90s, we have half the amount of publicly traded firms in the market than we do now. But you have to wonder, did Carson Block kind of top tick here?
In what way?
He wants to invest in the Mag 7 now?
Oh, I see. That's a good point. I mean, this is the debate, right? I mean, the debate is, have these incredible gains that we've seen, 13% annualized over the past 10 years, pulled forward some of the gains that we would have seen over the next 10 years.
I mean, his point, though, is you have all of these passive buyers. You think about 51% of all assets in mutual funds, in ETFs, they're kind of price-insensitive buyers. They're just investing in these indexes. So a tug of war.
And he says, hold your nose and buy the Mag 7. We're going to talk to Eric Johnson a little bit later from Cantor Fitzgerald.
We certainly are.
He may favor the smaller cap stocks.
He certainly does.
And we're very much looking forward to that. And we're going to talk to Matt Gibson from Goldman Sachs. So a lot coming up on this show, including Marianne Bartels next. This is Bloomberg.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977
when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
All right, we are just moments away from the start of cash trading to kick off this week. This is Bloomberg Open Interest. I'm Matt Miller. You can see futures are down a little bit, but of course, we hit another record high on the S&P on Friday. 6 weeks in a row of gains for stocks. We're up more than 23% year to date, so we're doing very well in this stock market. You can hear the opening bell ringing. 3M. Minnesota Mining and Materials, ringing it down the New York Stock Exchange over the NASDAQ market site. You have this CEO of a Retail Opportunity Investment Corp. It's a REIT there, along with, I guess, a ton of friends and family, unless that little kid works there. So we could see a little bit of a loss today. Obviously, after such a big run, you want to take some profits, but we've had KD Greifeld 6 weeks in a row of gains and just record after record high, outpacing strategist estimates.
Yeah, best start to a year since, I believe, 1997. Like you said, up over 23% on the S&P 500. It makes sense that maybe we're taking a little bit of a breather, especially when you consider all of the earnings that are coming in the next 3 weeks. The S&P 500 currently lower by about 0.1%. That's pretty much unchanged. The NASDAQ 100 a little bit more direction, down about 0.2% on your big tech benchmark. And then you take a look at the small caps, not doing too much. Currently, I'm going to call it unchanged. You look under the hood, though, and we do have some action, and we go to Boeing for that. Shares higher after the plane maker reached a tentative deal with the union. Now, that agreement raises pay by 35% over 4 years. They vote on that on Wednesday, the same day that Boeing reports earnings. So mark your calendars. Shares currently up about 3%, Shanali.
Also watching Spirit Airlines, a lot going on in the air world today, surging more than 37% this morning. U.S. National Bank Association agreed to extend a deadline for the carrier to refinance its bonds for 2025. And of course, you can see the stock investors like it. Shares actually gaining almost 40% now, Matt.
And we're seeing a ton of volume for shares of Oklo. It's a developer of advanced nuclear systems backed by Sam Altman. Share prices have soared more than 100% in the past week because it's like peanut butter and chocolate, right? You get nuclear and AI. Those are like this year's themes and this decade's theme. Bloomberg's Abigail Doolittle is here to break down Wall Street's increasing interest in nuclear energy. Abby?
It certainly is increasing. Take a look at the shares of Oklo over the last week or so, including last week, up more than 100%, 113%. And it's a new flavor of AI because, of course, the driver for the demand for nuclear power, electricity, has to do with AI. AI and the data center. So let's take a look at these shares over the longer period of time here, or actually take a look at solar versus the nuclear ETF. The nuclear ETF up 27% over the last 6 months or so. Solar, on the other hand, down about 7.4%. So investors assessing the idea that nuclear is better suited. In fact, if we take a look at the top stocks on the S&P 500, because in terms of this hot trend for nuclear, we of course have heard about the deal with Microsoft and Google, and then last week, I think it was last week or it was the week before, Amazon and Ken Griffin signing a $500 million deal. These are the top stocks on the S&P 500. Vistra, a utility, Constellation Energy, a utility, and then NVIDIA, of course, AI, and then Palantir Data AI. So these are the top stocks. The driver for the energy, and then the energy themselves, Vistra, not so bad, up 241% right now, Katie, year to date.
All right, just delicious. Abigail Doolittle, thank
That's
you
amazing.
so much. It is amazing.
Did we call the CEO of Vistra?
Yeah, over and over again. The CEO of Vistra, please come on with us. But at least for right now, we have a great conversation. Let's talk to Sanctuary Wealth Chief Investment Strategist, Marianne Bartels. And Marianne, we've only been on the air for 34 minutes about, but all we've been talking about is David Kostin's call over at Goldman, basically calling for a lost decade for the S&P 500. He thinks annualized gains will only be about 3% over the next 10 years. Marianne, I'm curious where you fall.
Well, basically my entire career, which spans 40 years, I pretty much have heard that the next decade was not going to be as good as we currently are. When I see forecasts like this, it makes me more bullish. I love having a bearish tone when we're hitting record all-time highs. It means that we can continue to go up.
How far up, and where do you find those places that keep on driving the index higher if you believe that you could still be bullish at these levels?
So I really am a believer that the leadership of this market remains tech and tech related. We're in a secular bull market, and secular bull markets can last for 15 to 20 years. My best educated guess is that we're going to be in a secular bull market to the end of the decade, driven by technology and tech-related companies. And so in the beginning of the year, we were very bullish, and my high-end target was 5,800. But also near the beginning of the year, we introduced a longer-term target of 6,000 to 7,000. And we've had to revise that by year end. We could even hit my longer term target of 6,000. But I still see 7,000 as a very achievable target over the next 12, 16, 18 months for the market.
What is that based on beyond technicals? Are you looking at earnings performance as we see, the S&P 493 kind of broaden out? I think they're expected to show earnings growth of 12 to 16% over the next 5 quarters. The Mag 7, although the earnings growth is going to slow down, still expected to earn 17 to 20% or grow earnings 17 to 20% over the next 5 quarters. How do you see the march to 7,000 being driven, Marianne?
I think that's a really important question. Is this just what my father used to use this phrase called air pudding and wind sauce? Is there really nothing to this? Or is there substance to this rally? And I believe there is substance to this rally. We're in earnings season right now. It's very early, but we're seeing companies beat on expectations. And we're seeing what has been the leadership of the market, which really tech and tech related, really coming in with the earnings. And one of the things I learned years ago is when earnings are scarce, it's driven by a growth cycle. You don't get a value cycle until you have an abundance of earnings. We don't have an abundance of earnings. We do have earnings. I would argue that this remains growth. And what I've been saying is that I think we're going into a super cycle or a super mega cycle for growth being led by technology. So I do see it fundamentally sound with earnings. And, if you had said to me, even 3-5 years ago, that the Fed would cut 50 basis points with economy growing at 3%, inflation falling, and you're at basically full employment, that's not what my forecast would have been. And here we are with the Fed trying to recalibrate and get to neutral. I think that keeps the economy strong. The other surprise is we have oil falling. Oil hasn't spiked up with all the geopolitical tensions. That puts more money in the pocket of corporates and also the consumer. The other thing that many people don't realize is when you're in a secular bull market, PE multiples expand. So I do think you get a combination of PE multiple expansion with earnings.
Expanding further than where we are now? I mean, aren't we looking at 22 times forward earnings?
So this is where I really differ from the markets. When I looked at the secular bull market from the 1980s to the peak of 2000, what was extraordinary is that you actually traded in a band that led to record all-time high PE ratios. I think we're repeating something very similar to what we saw from 95 to 99. There we had the invention of, computers and the internet. Here we have AI. I think this is going to allow us over time to expand PE multiples, and I would not be surprised by the end of the secular bull market that we reach actual record PEs. Not there yet, but I do see room for multiple expansion, especially in a lower interest rate environment.
Well, let's talk about the rest of the index, and let's talk actually about small caps. Let's go to the Russell 2000, for example, because we're speaking to Eric Johnston in the 10 a.m. hour. He, for example, is very bullish on small caps, and it's been a real hot and cold rally, and you bring up, of course, lower interest rates. Lower interest rates would theoretically benefit those small caps, but how are you feeling about those tiers of the market?
Well, in my opinion, small caps are in a secular bear market, the opposite of large cap or mega cap. And again, these cycles can last 15 to 20 years. Now, this doesn't mean that small cap can't go up. I do believe that they can rally, but I don't think they're going to beat the S&P or NASDAQ. In fact, if there was an index that I really wanted to focus on, if my thesis is correct, is the NASDAQ will be the best performing index.
Marianne, we thank you so much for your time today. Of course, that is Sanctuary Wealth Chief Investment Strategist, Marianne Bartels. We're going to bring you now some movers on our radar, of course, after the market opens. Some things moving hot. Kenvue shares surging after activist investor Starboard built a stake in the company. You're watching Kenvue up about 6% now. And remember, activism hot in the market. We're going to talk about more about that in a minute here. But also, we're taking a share, Lumen shares being higher on an AI partnership with Meta. Lumen Technologies now up about 15.3% as the market opens. And of course, we know that this has been an interesting stock. We've had the CEO on this program before, an up and down kind of stock. But seriously, now year to date, up 323%, guys. So a lot of fuel to that fire. But we'll talk more about that AI trade later in this show. Now, coming up, winter is coming, but Canada Goose may be dropping out fashion before then. Top Calls is next. This is Bloomberg.
Names in tech are on Bloomberg.
A large number of countries are subsidizing their regional data centers so that they could become able to build out their AI infrastructure. They recognize that their country's knowledge, their country's data, digital data, is also their natural resource. Not just the land they're sitting on, not just the air above them, but they realize now that their digital knowledge is part of their natural and national resource. And they ought to harvest that and process that and transform it into their national digital intelligence. And so this is what we call sovereign AI. You could imagine almost every single country in the world will eventually recognize this and build out their AI infrastructure.
Nobody covers technology like Bloomberg. Context changes everything.
This is Bloomberg News Now.
News when you want it at the touch of a button.
Another volatile day on Wall Street. We're seeing big moves.
All eyes on Capitol Hill as Democrats and Republicans prepare.
Today's job numbers casting doubt on the Fed's next move. Inflation remains front and center. And that's news when you want it with Bloomberg News Now. Get it 24/7 on the Bloomberg Business app, Bloomberg.com, and anywhere you get your podcasts.
Bloomberg News Now. Context changes everything.
There is this real momentum from Wall Street. We are basically deep in the European earnings season. Take a look at how we're faring when it comes to Asian markets.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
All right, welcome back to Bloomberg Open Interest. Let's take a check on stocks. About 13 minutes into the U.S. trading day, you can see a bit lower, a bit soggy when it comes to the start of this trading week. The S&P 500 off by about 0.3%. Same story if you take a look at the NASDAQ 100. And remember when small caps were winning? They aren't anymore. The Russell 2000 currently off by about 0.3%. Meanwhile, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, UPS gets a downgrade over at Barclays. Analysts at the bank see near-term earnings risks due to weakness in freight. They're also seeing some longer-term pressures thanks to volume loss and competition. Next up, we have Gilead upgraded to outperform at Leerink. Analysts say that Gilead has a chance to reverse negative sentiment around its oncology franchise after some promising readouts for developing products. And finally, Goldman cuts Canada Goose to a sell. Goldman sees the Canadian company lagging its peers in the sector as the brand momentum normalizes, Matt.
All right. Thank you very much for that. Canada Goose, are you a Canada Goose wearer?
Sure, I am. I really get confused whether I should be buying Canada Goose or Montclair. They're kind of the same thing, aren't they?
Montclair seems too shiny to me. Do you not think?
I'm more of a, I like the Canadian wear. Just
there's someone, by the way, there's a mobile phone.
I've been told to move on.
Someone's phone is in the ceiling here and continues to ring. I don't know.
Anyways, we're going to work through that.
Yeah, let's Shanalia is moving me on. The team at S3 put together their latest short signals. Lam Research leading with a 51% jump in interest, but major names like Boeing and AMD made the top 5. Here with more is Bloomberg's Bailey Lipschultz. Bailey, so great to have you on the program.
Is that your phone, Bailey?
I wish it was. No, my first question was like, who's in the ceiling?
I want to climb up the wall and go get it. But
in any case, we pay very close attention to S3 short data. It often tells us a great story. What are you hearing this week?
When you look at the report that they put out, basically kind of digging through some of the companies that saw notable jumps in short interest over the last week that are reporting earnings in the near term. So really this entire report lays out the fact that when you typically see a jump in short interest, that can correlate to a decline in the share price. So when you mentioned it, we're looking at stocks like Boeing, AMD, also in the the insurance space, Allstate and Everest Group. One thing to keep in mind, though, all of these companies are reporting in the near term, but 2 of them are in the chip space. This is so funny, I can't even focus.
For the viewers, of course, the phone sound is back.
Yeah.
That's what we keep referencing.
But so the chip space, obviously under pressure after the ASML results, as well as it relates to insurance. When you have 2 hurricanes, there's so much uncertainty around that. So that could be it. But the thing you have to keep in mind at the end of the day, still small jumps. So Lam Research, only 2.6% of shares outstanding are sold short. So while it is a large jump week over week, that could just be one person hedging a bet or putting a kind of bearish bet ahead of earnings.
You know, maybe it's background music. Maybe it's not a phone.
Yeah.
Maybe it's just someone introducing some light
all in
music.
our head.
Some elevator music. But anyway, so Bailey, it's interesting, of course, to see what short sellers are targeting ahead of earnings. But When it comes to the market for short sellers, I mean, this has been an absolutely brutal market. It feels like companies don't really die anymore.
No, and it's tough, Katie, because of so much of index investing really taking over the world. So maybe you're bearish on a company like we've seen a number of times in the crypto space, and you're willing to wage an activist campaign against it. But if investors are buying it simply because it's in the Russell 2000 or it's in a different ETF, then it's kind of an uphill battle, because a lot of investors aren't actually paying attention to the actual fundamentals on a lot of these companies.
That's like what Carson Block was saying about that passive bid.
You know, even though he says that he could have just been levered long Mag 7, let's pull up some of his wagers, because BXMT, this is the Blackstone Real Estate Trust, has actually been down about 10%. He called that it would cut its dividend. It indeed cut its dividend faster than he expected. It's down 11%, but the wager has kind of plateaued, hasn't it? Also going to pull up Eurofins as well. This is another company that has very much, and both companies, by the way, have fought back against his allegations, but the Eurofins stock has also been down about 7% this year. It's not like you can't make money off of shorting, Bailey, is it?
No, not at all. But I think the big question and the big unknown is you can be right and in the long term, but when you're taking on a short bet, you're paying fees to keep on that bet. You're taking on kind of unlimited risk if the stock rips, which we saw with GameStop. So there's kind of, you're betting against the market, you're betting against companies, but there are underlying costs that aren't typically at play if you're just buying Apple or buying any other name in the Mag 7.
To be fair, he said he could have had leveraged longs on those stocks and still been in the same place financially.
Yeah,
so he wasn't saying that he was unsuccessful with his shorts. He's just saying, and they cause a lot of agita. There was, I think the technical term was BS.
He could have slept easier at night had he just, levered long on the Mag 7. But there's the market conditions for shorting. There's also sort of the reputational risk. There's this overhang of regulation, for example. You think about short sellers being looked at by the SEC, for example. In terms of things that would keep you up at night, I have to imagine that's one.
Yeah, and I talked to a lot of these short activists and kind of digging through some of their theses on individual names, on individual trends. We saw a number of activists going after companies that have benefited at least their stock prices from the AI trend. And the big uncertainty is you look at a company like Lumen Technologies. That was a Kerstale short report from just a few weeks ago, about a month and a half ago. Well, that stock's back up. So whether or not that was a short-term immediate play where you short the company and then cover, which we've seen is kind of the basis of the SEC investigation, or actually bet against a company and hold on to it for the long run. Obviously, when we think about unsuccessful campaigns, think of back to Herbalife when you go Bill Ackman versus Carl Icahn.
I just want to point something out. We continue to reference this Carson Block interview with Haslinda Amin had earlier on Bloomberg Television. You can watch that by going to Bloomberg.com. And I also wanted to quickly ask, you said short activist. Is that a new phrase, or did you just...
Well, activist short sellers. Well, that's the thing. You can bet against a company and be short, but if you're coming out with these 40-page 300-page reports, that's the activist. You're actually pushing back against it. Yeah.
Just flip the words.
Well, guys, we got to leave it there. Of course, now a lot of these guys throwing in the towel, going long instead. Bailey, we thank you so much. That is Bailey Lipschultz of Bloomberg News. And coming up, we're going to talk about another form of activism. Kenvue shares jumping after activist Starboard, traditional way activists, announced a large stake in the maker of Tylenol. We're going to take a look at increased activist activity next in today's Wall Street Beat. This is Bloomberg.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
By our estimate, there's one in four companies in the S&P 500 has an activist investor in the top 20 shareholder registry. So you can imagine there's a lot of private engagement across that. But what's really changed is not just the activists, but it's the broader investor mindset.
That was Kiran Murthy, Consello Financial's head of shareholder advisory, and it gets us to today's Wall Street beat, increased activist activity. He's saying here that 1 in 4 S&P 500 companies have a activist of some type, private or public, and we just saw Starboard build a sizable stake in Kenvue, and Kenvue shares reacting positively to it. Joining us now, Bloomberg's Liana Baker. You think about the amount of shareholder activity that's been going on. You have CVS, now a new CEO announcement off the top of it. Kenvue just spun off from J&J, and now you already have an activist wanting change at the company. What exactly is going on?
So at this point, we haven't confirmed that Starboard is agitating at Kenvue. It's a Wall Street Journal report, but tomorrow the Starboard head is going to speak at an activist conference, and maybe we'll get some more news on that. And Kenvue, it might not be a company you've heard of, but you know the brands. They own Neutrogena, Tylenol, Aveeno, and all these different things. And when it spun off from J&J last year, the stock just, went up the first day, and then it didn't really budge, and it's below where that S&P gains are, and that's why you see, Starboard potentially coming in and pushing for changes.
Let's compare and contrast the different types of activists in this market right now, because we were just talking about activist short sellers, for example, who've had a really rough ride overall with the fact that this market environment has been great for the bulls. What about the backdrop makes this a good market for traditional activists versus those activist short sellers?
So the companies that activists are targeting are already doing a lot of the things that activists like. Spin-offs. Kenvue was a spin-off, and other things like we looked at CVS before they announced a new CEO. They had thought of a breakup. We don't know what's going on at Pfizer, but these are things that activists push for already. So the fact that companies are doing this means it could be a low-hanging fruit thing to come in as an activist and maybe take credit or not have to do too much heavy lifting to get these companies to do what they want.
So what do you think Starboard may want to do with Kenvue? As you said, they have all these well-known brands, Band-Aids, Tylenol, Zyrtec. What can they do other than sell like the most well-known brands in consumer healthcare?
When you look at a portfolio of so many well-known brands, you have to think, could these brands somehow have more value in a different owner? So maybe spin-offs is something, again, I'm just speculating.
Spinning off the spin-off?
Maybe J&J wants to buy in.
Divestitures, carve-outs. Private equity, they love these brands that they could, roll up together and be successful. And it really has been a trend for some of these consumer names to just, be sold for, $1 billion for this, $1 billion for that, or more. But it's too early to say what they'll do.
Just a quick observation here. I am so amused by how many of these activists are targeting choppy M&A strategies. Pfizer, nothing good happened there for a while. CVS, pretty much undoing a $70 billion deal, Matt, and it's just stunning to see that spin-offs are now the ones in vogue.
Yeah, I mean, it just goes back and forth. It's a pendulum that swings throughout the years. Liana, thank you so much for joining us. Liana Baker covers deals for us, and she's our Yankees fan, a resident Yankees fan, so congratulations to you on that as well. Coming up in the next hour, we speak to Mina Hawk, the CEO of Tony Roma's. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Monday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're also streaming live on YouTube, so head over to youtube.com and search Bloomberg Podcast. That's where you'll find us. Alex Steele out today. Not to worry. Norma Linda, Bloomberg News Markets reporter, joining us here for the next 2 hours. So that's a good thing. Coming up, Gina Martin Adams, Bloomberg Intelligence. She's our chief U.S. equity market strategy. I want to get her thoughts on these markets here because we're getting into the teeth of earnings, and a lot of folks are saying these earnings need to be strong to support this market. Disney looking like they're going to be moving to make some changes at the CEO spot that they've long promised. They named a new chairman of the board there to kind of get that process moving. We'll check in with Geetha Ranganathan. She covers all the media companies. Phil Orlando, chief equity market strategist and client portfolio manager at Federated Hermes. He's going to join us to give us his market call. So a lot coming up in the next couple of hours. Let's kick it all off with Lisa Mateo.
We got it. We have Market Drivers brought to you by IBKR with Interactive Brokers Forecast Trader. You can trade your views on the 2024 elections. Just answer yes or no. Visit ibkr.com/forecast and get started today. All right, stocks. We're mixed right now in a busy week for earnings. Traders just awaiting reports from Tesla, Boeing on Wednesday, as well as a bunch of other companies throughout the week, includes General Motors, IBM, UPS, and Coca-Cola, to name a few. Now, 3/4 of respondents in the latest Bloomberg Markets Live poll survey, they expect this reporting season to give the markets a boost. Right now, NASDAQ up 10 points, Dow down 94 points, and S&P 500 down about 4 points. We have the 2-year yield 3.99%. That's up 4 basis points. The yield on the 10-year 4.14%, and that's up about 6 basis points. To commodities, gold trading at record highs. Tension in the Middle East, also ahead of next month's presidential election. We have spot gold up about 0.5% at $2,736 an ounce. Over to oil, Brent crude, $74 a barrel, up more than 1%. WTI crude, $70 a barrel. Shares of Boeing, they're higher. They're up about nearly 4%. And this is after union workers. They worked out that tentative agreement with the company, raises pay by 35% over 4 years. Here's the thing, though. The machinists still have to approve that deal. They vote on Wednesday, which actually happens to be the same day that Boeing reports its earnings. Spirit Airlines, their shares down, up 48%. It struck a deal to extend this key debt refinancing deadline to late December. That's why those shares are higher. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Nora.
All right, Lisa Mateo, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele. Nora, thanks so much for joining us again.
Happy to be here.
Awesome stuff here. We got a lot going on here. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. That is the internet, and youtube.com is, I think, how it works. And then you just search Bloomberg Podcast, and that's where you kind of find us here. Kind of mixed on the screen as Lisa was just reporting. They got a little bit of a lift to NASDAQ, but everything off just slightly. Let's check and see where the action is under the hood. Bailey Lipschultz, I haven't seen this guy in forever.
He's a busy man.
I guess
Hard
what they
to
tell
catch.
me.
He's
So,
always doing
he covers
amazing
all the markets
things.
for us. Bailey, what are you looking at today?
Yeah, start with Lumen Technologies. So when you look at this company, you say, all right, $7.3 billion in the wireless telecom space, helps build out the infrastructure for a number of technology clients. Up right now, 7.5%, trading at the highest level since October. But when you look at it on a year-to-date basis, this is a company that's up almost 300%. Today's latest rally coming after a partnership with Meta to help build out its network capacity. And guess what they're going to do, Paul? AI. So that's all that really matters. This is one of the companies that has really been kind of reworking its business to cater towards artificial intelligence and the potential spending from that. This is a company that, when you look back even in late June, was trading for about $1. Now it's north of $7.
Wow.
I mean, it's up almost 300% year to date, and it's got a market cap of $7.4 billion. Not too bad.
Quite the move there. You're also looking at Kenvue. What's going on there? Some activist action?
Activist action. It feels like activists are getting kind of more antsy right now, maybe. Targeting Kenvue is Starboard Value. This coming after the company went public via a split off from J&J back in May 2023. Stock's only up 5% from then, so if you compare that to pretty much any other benchmark, grossly underperforming. When you compare it to the S&P, up about 23%. So basically the Starboard position and push, according to a number of media outlets, is trying to help it rethink how it operates. This is the company that makes and sells Tylenol, Listerine, Neutrogena brand, is also struggling against some rivals from private beauty companies. So definitely an interesting space, in a company that, if it was still under the J&J portfolio, people would know, but it's kind of its own beast these days.
Yeah.
Boeing having a good day today. What's happening there?
Yeah, as Lisa mentioned, a tentative agreement from the union on wages to end the strike that has been going on for about 5 weeks at this point. This is a company that has to raise a lot of money. We've been reporting that they're looking at the equity market, whether that's straight out stock or convertible debt, convertible bonds that could be converted into shares. Stock's down about 11% in the last 12 months, really struggling. This is going to be a key hurdle, as Lisa mentioned, though. Earnings are on Wednesday, so the earnings will happen. The call will happen on Wednesday. We won't know what's going to happen with the agreement. We actually did see workers vote against the last one that was backed by the union. So it's going to be certainly one thing to keep an eye on. Analysts did seem optimistic that this one will clear that hurdle, so certainly going to keep an eye on that. But when you have potentially in the market for north of $10 billion in equity and converts on top of earnings, and it's one of the biggest, most well-known U.S. companies, especially from an industrials perspective, definitely one to watch.
You also, in your day job, you follow the new issue market. What's the IPO market looking like between now and year end? Is everybody just going to wait until the election's over? Is that kind of the thinking?
So Ingram Micro is in the in the chip space, in the technology space. They're expected to price on Wednesday, I believe, and trade Thursday. So certainly one we're going to keep an eye on. They seem to be the last big one before the election really closes us down. We may or may not have one or two try to go post-Thanksgiving, pre-year-end holidays, but it does seem like it's going to be another quiet year.
All right, Billy Lipschultz, thanks so much for joining us. Billy Lipschultz, he covers all the equity markets for Bloomberg News. Turn to this market here. There was an interesting piece of research from our good friends at Goldman Sachs saying that The decade of big S&P gains is over. Interesting. I mean, it's getting a lot of read on the Bloomberg terminal, so the click thing is working for them. But we'll have to see what the pros say. Gina Martin Adams joins us, Chief U.S. Equity strategist for Bloomberg Intelligence. I don't know if you got a chance to read that, but how do you think about the next several years in terms of this market? Has the easy money been made? Kind of what Goldman's suggesting?
Well, look, somebody else forwarded this article to me this morning, and my first instinct of, so people have been saying this since 2010.
Yeah.
And the equity market continues to sort of continue to defy expectations. I mean, this is part of what's framing this wall of worry that the equity market has been able to climb for a decade and a half now. Standard traditional models would have said, based upon an equity risk premium, which is relatively limited, you should expect low single-digit returns. This is, kind of consistent expectations. And yet, what has happened repeatedly, especially since COVID, is companies have come in and just pummeled earnings growth expectations. Most recently, over the last 2 years, it's really been isolated to the big seven in the AI trade. But nonetheless, the result of that is better than expected returns because we have better than expected earnings growth. So you can only do so much to frame the earnings situation utilizing macro indicators, utilizing historical relationships, understanding the relationship between stocks and interest rates. Sure, that's a big part of the puzzle. But if earnings continually come in and companies continually expand margins faster, continually gather market share, if the U.S. companies themselves continue to beat expectations, you're going to get faster returns. And that's my big lesson learned of the last decade and a half is you can only do so much to set expectations with macro conditions because the companies have idiosyncratic risks and idiosyncratic opportunities that are not always identifiable looking at the big macro picture.
Right.
So that's the offset. You could continue to see companies beat expectations, and you get better returns as a result.
I mean, talk us through what expectations are like for this quarterly earnings. I know you were on our equities call more recently, and you discussed the outlook heading into earnings. Talk about the low bar here.
Yeah. It's really fascinating, actually. For the third quarter, analysts are forecasting just under 4% earnings growth. It's really slow relative to the 13% we had last quarter. A lot of that is coming from this sort of depressed conditions in the energy sector, in particular, where oil prices just can't get off the floor. The energy companies are dealing with transition effects and really struggling to make earnings bogeys and even kind of produce some earnings growth in this landscape. That's a big drag on the index. But broadly, I mean, what did we learn last week? 90% of financials beat expectations yet again. The bar is still rising for financials, but very, very slowly, and they keep coming in and beating expectations. The vast majority of the analyst community was suggesting that, hey, because we got a rate cut, that might not be so great for financials. Turns out to be fine. Because expectations were so low. So I think that we're set up for another pretty easy beat. There are a couple of really interesting things that happened last week, though, from a charges perspective. Boeing and Lilly are charging enormous amounts of one-time charges, and that's sort of depressing sentiment as well. These are one-off issues, but nonetheless, they do call into question earnings quality to some degree, so we're going to talk about that. We're going to have to address that over the next couple of weeks. Will they be one-offs? But we get 20% of the market cap reporting this week. Another huge chunk the week after that. So after the next 2 weeks, we'll have a really good sense of where company earnings lie.
And given the earnings that we are seeing, real quick, 30 seconds, what's the valuation of this market look like to you?
Yeah, I mean, look, the fair value, according to our fair value model, is somewhere around 21 times earnings. We're sitting closer to 22, but if you exclude the big seven, you're well below 20. So it's a mixed picture still, where we're paying a whole lot for the biggest stocks and for AI-centric industries, because that's where our strongest earnings growth prospects are, but we're not paying a whole lot for the rest. And that leaves an opportunity for the rest to have some re-rating, even if we continue to pay a whole lot for the big guys.
All right, Gina Martin Adams, thank you so much. We appreciate that. Gina Martin Adams, she does all the strategy stuff, equity strategy stuff for Bloomberg Intelligence. Appreciate getting a few minutes of her time. One of the companies that's near and dear to my heart, Walt Disney Company.
We love it.
Big fan of the MIC. They need to get a proper succession plan in place for Mr. Bob Iger.
They do.
We had a move today that kind of, I think, gets us a little bit closer. The Walt Disney Company named Morgan Stanley Executive Chairman James Gorman as chairman of its board effective January 2nd, and his responsibility is to manage this succession plan. Geetha Ranganathan joins us. She's the media analyst for Bloomberg Intelligence. She's based down in Princeton, New Jersey. So, Geetha, I think James Gorman, again, former CEO of Morgan Stanley, has got a ton of credibility with investors, a ton of credibility with global Wall Street. Presumably, if it's in his remit to get a smart, smooth succession plan, I kind of have some confidence in him. What do you think, and what are the analysts and investors that you talk to, what do they think about this news?
Yeah, absolutely, Paul. So I think this is the #1 issue for this company right now. I mean, succession planning has obviously not been Disney's strong suit. You know, they had a botched succession attempts now multiple times. This is important. I mean, you have arguably one of the best executives in the business in James Gorman, who led such a smooth, orderly transition. You know, in his own CEO transition, just did it in 5 months with all internal candidates. So if it's going to be orchestrated by him, I think obviously he's been on the succession planning committee. It's his #1 priority, and I think it definitely gives investors a lot of confidence. The one thing, though, that we have to mention here is that the early 2026 timeframe that they have announced in terms of the new CEO appointment, I think that's a little bit later than what investors were expecting. I think most investors were expecting it to happen in 2025.
I mean, things have really been tumultuous as we think about succession plans. What are investors looking for from a successor here?
So right now, all that we know is that you have the 4 internal chiefs. So you have the Parks chief, Josh Tomorrow, you have ESPN's Jimmy Pitaro, and you have the 2 big creative heads on the TV and the film side, Dana Walden and Alan Bergman, who are all front runners. So this is, leading a company like Disney is really, really challenging because, you had a Parks guy in Bob Chapek who was leading the company, and obviously that turned out not so well because, the creative side was completely neglected. And now you have Bob Iger kind of coming back in and cleaning up all those relationships that were broken with the Hollywood community. So it's going to be interesting to see whom he really picks. Obviously, the 2 front runners here are Dana Walden, who is a very well-known, very well-respected TV executive. She has deep, deep ties in Hollywood. She actually came over from Fox. She has built a lot of credibility within the industry. But she has absolutely no experience with the Parks business. And remember, Parks brings in almost 55 to 60% of Disney's profit. So this is critical to the future of the company. Josh Tomorrow on the other side, of course, he's an out-and-out Parks guy, has absolutely no experience with creative. So this is where it gets really, really challenging. So it's going to be interesting to see whether Bob Iger thinks having that creative element is more important or whether it's, again, going to be a Parks pick like Bob Chapek.
So, Geetha, probably at the end of the day, only one person counts here, and it's not James Gorman. It's not the board. It's Bob Iger. What do you think he wants to do? Will he be ready to go when this happens?
I think he will be ready to go. The question is, does he want to stick with an internal candidate? I mean, you know this very well, Paul. He's been doing this now for a very, very long time. There was first, of course, the Jay Rizzullo thing. Then, of course, there was Bob Chapek. So there's always kind of been this proclivity towards an internal candidate. But having said that, for the CFO, they did look outside with Hugh Johnston. So again, it's going to be interesting to see what happens and what he really wants to prioritize. If he thinks this time around the creative element is going to be more important, or whether he wants more of an operations kind of person. But I think, yes, he will go. His contract ends in December 2026.
All right, so if James Gorman calls me, I'm going to say, just bring back Tom Staggs or Jay Rizzullo. It was set up so perfectly back then, and then I don't know what happened. Bob, just didn't want to let go, I guess. All right, but Geetha, thanks so much for joining us there, getting an update there on our good friends at Disney. Geetha Ranganathan, she's a media analyst at Bloomberg Intelligence. Just looking at Disney stock, I mean, it's only up 7% this year, so really lagging the market, and it goes to a number of issues, most notably this continued uncertainty around the evolution into a streaming company,
right?
Number 1. Number 2, maybe the consumers kind of softening on the margin, which goes to their parks business, with Geet just mentioned is the biggest profit contributor. And then number 3, you've got the succession uncertainty, I guess.
Everyone wants to know. I mean, I'm looking at Wall Street, and we're seeing about 72% of analysts have a buy rating, 25% are hold.
Yep. Yeah, it's interesting. I mean, you look at the Disney company, and you could say, arguably the best entertainment assets in the business. And the question is, can they fully monetize them in this new world order, which is less reliant upon cable distribution of your programming and more towards streaming? So that's definitely an issue.
Quite the shift.
For Disney and for all of the traditional media companies as they navigate the transition to streaming. S&P 500 absolutely unched on the day, if Lisa Abramowitz is listening. The NASDAQ up 51 points. That's 0.3%. 10-year Treasury yield 4.15%. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Broker Studio, I'm Lisa Mateo. Stocks pretty much taking a breather after that rally that drove the market to its longest weekly run this year. Goldman Sachs strategists say U.S. stocks, well, they're unlikely to sustain that above-average performance of the past decade. Investors turning to other assets, including bonds, for better returns. More economic data on tap this week, including the Fed's Regional Economic Survey. We have the Beige Book on Wednesday. Also this week, existing home sales, new home sales, factory orders for durable goods, and also can't forget that read on sentiment. And we had some more Fed speak. Lori Logan repeated her call for the U.S. Central Bank to lower interest rates at a careful pace. Right now we have the NASDAQ up 0.2%, 40 points. The Dow down 0.2%, 100 points. And we have the S&P 500, little change, down about a point. We have the 2-year yield, 3.99%. That's up 5 basis points. The yield on the 10-year, 4.15%. And that's up about 6 basis points. Shares of Tylenol Listerine maker Kenvue up more than 7%. Sources telling the Wall Street Journal that activist investor Starboard Value has a sizable stake in the company. And shares of Humana, they're up about 0.5%. And that's after a Bloomberg report that Cigna has revived efforts to buy it. And as you've been hearing on Bloomberg Intelligent News from Walt Disney, yes, it's named Morgan Stanley's James Gorman, chairman of its board, also says it plans to name a new CEO in early 2026. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That's a Bloomberg Business Flash. Paul and Nora.
All right, Lisa Mateo, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele, and I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Let's turn to China a little bit here. We have some more reporting out of Chinese banks. They cut their benchmark lending rates after easing by the central bank at the end of September. Now, this is part of a series of measures aimed at reviving economic growth and halting a housing market slump. The question for a lot of investors is this it? Is there more? And is it enough? Fortunately, we have an expert here. I'm talking about a serious expert on all things China. Tom Orlik, chief economist for Bloomberg Economics. He spent many years living and working in China. So Tom, just frame out for us what we're seeing from the Chinese government here as they try to revive their economy.
Great to be here, Paul. So back in September, we had a big stimulus signal from China's Politburo. They said they were going to revive growth, put a floor under stocks, end the slide in the property market. And they made a down payment on that with a cut in interest rates. Now, the way monetary policy works in China is there's actually a lot of different rates to watch. The most important one is from the PBOC, the central bank, and that's what came down in September. Now what we're seeing is the second shoe dropping. Banks are following the PBOC and saying, well, if the central bank's cutting rates, we're going to cut rates as well. So this is the kind of the follow through of that initial September announcement. The big question, as you flag, is, well, what comes next? And I think what markets are waiting for is fiscal policy to start coming into play, for markets to really believe that the narrative on China has changed after some pretty miserable years of kind of slow motion property implosion. What they need to see is the government opening its wallet and putting some fiscal money to work in the economy.
Well, thank you for that distinction. What does it mean for consumers and lending activity? Is this enough to get people back out in the market looking to buy houses?
So that's a great question, Nora. And on its own, the answer is no. There is a huge structural problem in China's property sector, massive overbuilding, concern that there needs to be a kind of deep adjustment in prices to bring supply back into line with demand. And against that backdrop, 25 basis points off mortgage rates, well, it's certainly welcome. It's certainly a move in the right direction. But in terms of the magnitude, it's not sufficient to turn the situation around. That's why markets are pleased to see the PBOC and the banks getting into action, but what they really want to see is the Ministry of Finance and fiscal policy getting into stimulus mode.
Well, what is that key number? What are people discussing will be the point in which people are ready to rush back in?
So we've already seen the market rally pretty significantly since that Politburo announcement in September, and then give back some of those gains when the hoped for bazooka of fiscal stimulus hasn't arrived. Now, when you think about what that magic number is going to be on fiscal stimulus, there's a bunch of different numbers out there in the market. People are talking about 2 trillion, 3 trillion, 5 trillion, maybe even as much as 10 trillion yuan in fiscal stimulus. The view from our team on the ground, though, is that at least for 2024, we're just not going to see those big numbers. And the reason's pretty straightforward. China's actually a long way behind in terms of what it said the government was going to spend this year. They're a long way behind on their public spending. And so our view is that at least for 2024, we're not going to see one of those big numbers, one of the numbers with $1 trillion attached to it in terms of additional commitments to fiscal stimulus. We'll see accelerated efforts to spend what was already in the budget. And it's going to be 2025 when the Ministry of Finance thinks about what more could be required.
All right, Tom, thanks so much for your time. Always appreciate chatting with you and getting the latest from our good friends in China. Tom Orlik, Chief Economist for Bloomberg Economics. He is based down in Washington, D.C. Let's turn back to the U.S. markets here. Again, the S&P kind of down about 5 points, Dow off about 145, and NASDAQ up 25. We checked in with Phil Orlando, Federated Hermes. He is our go-to guy as we think about some of these markets. He's the Chief U.S. Equity market strategist and head of the client portfolio group there. Hey, Phil, I don't know if you saw this, but Goldman Sachs out with a note saying, you know, if you think about the S&P over the next 10 years, think about low single-digit returns as opposed to what we've seen over the past 10 years, which have been much better. When you see a note like that, how do you kind of digest that?
Well, I mean, Goldman's probably right. We've had such a phenomenal recovery in equities coming out of the depths of the pandemic, 4 years ago, 4.5 years ago, and just over the last year or so, that how much of this is borrowed from the returns that you might expect over the next decade. So Goldman, adjusting their capital market assumptions and saying, mid-single digits over the next 10 years probably feels right, particularly in light of the fact that we're sitting here with $36 trillion in federal debt and a total debt to GDP ratio of 125%. Those numbers aren't sustainable, and you've got to believe that at some point Washington's going to find religion on trying to step away from the sugar high that we've seen over the last couple of years with all of this massive amount of spending. That'll have potentially a deleterious impact on economic growth and ultimately equity prices. So directionally, I don't disagree with what Goldman said. The case for active management, though, is that what you want to do is you want to find good firms, good managers, good products that can do better than the average. Those top quartile performers that will help you generate the returns that you need for your, college funds or retirement funds or whatever else.
Well, Phil, let's talk rates. Of course, we just got that jumbo rate cut, just what felt like yesterday. And then here we're turning and we're going to be having another meeting in a matter of weeks. What do you expect to come out of that meeting? Of course, I know as you flagged, just a month later after that last cut, we're seeing an economy that could be seen as reaccelerating and a labor market that has strengthened. What does this mean for markets? Do we see a rally continuing after this next meeting, and what do you expect from the next meeting to come?
So to take a half a step back, we were surprised by the pace of the 50 basis point rate cut that the Fed gave us in September 18th. We think that the Fed needs to sort of get back to, that quarter point level, November 7th, December 18th, and then looking out over the next year and a half, a quarter point cut per quarter, and that would take us down to a terminal value of the funds rate, let's say by the middle of calendar 26 of about 3%. We think that's a reasonable pace. And then to your point, given the seeming reacceleration that we've seen in the U.S. economy over the last month or so, and sort of the sticky nature of inflation, and the fact that the labor market in September was actually surprisingly strong, Raphael Bostic, for one, the president of the Atlanta Fed, made a comment, I guess it was last week, where he said, you know what, maybe we should just skip November and come back in December and see where we're at. So our view is that the 50 we saw in September was probably a little too aggressive, and given sort of the tone of the economic data we've seen over the last month or so, ratcheting back to a more conservative quarter point pace is probably more realistic.
Phil, we're just starting to get into the real teeth of the earnings season here. What have we seen so far from the big banks that have reported, and what do you think the market needs to see earnings-wise from corporate America?
Well, the earnings haven't been bad. We're probably up 4% or so year over year, which is fine. We're probably going to end up beating expectations as we usually do. But importantly, the earnings season is going to be slower than the 11 or 12% year-on-year earnings we saw in the second quarter, and I think that's consistent with our soft landing thesis. We're not going negative. We're just going to slow down to sort of a trend, a pace that's above zero, but nowhere near as hot as the double-digit pace that we saw in previous quarters.
So expectations for this earnings season are low. Does that support a further rally when we're looking at equities more broadly coming out of this earnings season?
Well, we've seen a backup in Treasury yields from 350, 360. We're up to north of 410 now. Remember, price earnings ratios are inversely proportionate with the direction of inflation and interest rates. So the backup in yield suggests that price earnings ratio should be contracting. Yet the stock market hit another all-time record high last week. You've got stocks trading, the S&P trading at a forward multiple north of 21 times on next year's earnings. We're estimating $275 for the S&P next year. Yet the appropriate PE on stocks, given where Treasury yields are, is probably south of 18 times earnings. So you've got a valuation gap right now, of about 20% in round numbers. In my mind, the market's extraordinarily enthusiastic here. It's looking through and discounting very favorable Federal Reserve behavior, very favorable election results, very favorable trajectory of economic growth and inflation.
Right.
There's a lot of enthusiasm built in here that, maybe we ought to see a little bit of a pullback.
All right, Phil, thanks so much for that. We always appreciate getting your thoughts on these markets. That's Phil Orlando. He's the Chief Equity Market Strategist and head of the Client Portfolio Management Team at Federated Hermes. Zooming it in there from New York. Again, looking at these markets, the S&P off about 10 points, the Dow off about 180 points. That's 0.4%. Yet the NASDAQ eking out a little bit of a gain, up about 11 points. 10-year Treasury, 4.15%. WTI crude oil, it's up about 1.4%, $70.20. Gold, another record intraday, $2,730. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 10:40 on Wall Street. We do check markets all day long here at Bloomberg. We have got stocks at the lows of the morning right now with a 15-point drop on the S&P 500 index. The Dow, the S&P, NASDAQ, all in the red after last week's surge. S&P right now down 15 to 58.49, a decline of 0.2%. The Dow down 146, down 0.3%, and NASDAQ is down 37, a decline of 0.2%. 10-year at 4.15% with a 2-year 4.00%. Gold up $8 the ounce, trading at a record 27.29. We have got spot up by 0.3%, and West Texas Intermediate crude up 1.4%, 70.18 for a barrel of WTI. So stocks lower after a rally that drove the market to its longest weekly run this year. Traders gearing up for key earnings reports from Boeing and Tesla and UPS. As for the backdrop, Sylvia Jablonski is the co-founder of Defiance ETFs.
You know, I think tech earnings are going to tell us a big story. Netflix was the first one, although, you know, they're kind of their own niche in terms of reporting earnings. But it was good to see one of those big tech-heavy type of names come up with such a great earnings report and you know, strong consumer support and consumer spend in their report. So I think it bodes well for the soft landing.
Jablonski was interviewed this morning on Surveillance. She mentioned Netflix down by 0.6%. Disney making news this morning, down 0.3%. It has named James Gorman as chairman of the board, and it also says it will appoint a new CEO in early 2026. Again, Disney shares down 0.3%. Bottom line here, stocks lower across the board with the S&P down 13, now down 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We're live here in our Bloomberg Interactive Broker studio. We are streaming live on YouTube as well. So head over to youtube.com, search Bloomberg Podcast, and that's where you will find us. Tensions in the Middle East, the military conflict in the Middle East, still front and center for markets. We like to get some smart internal voices as well as external voices. And that brings us to our next guest, Ned Lazarus, Associate Professor of International Affairs at George Washington University, joining us via Zoom from Washington, D.C. Professor, thanks so much for joining us here. I'm just not sure what next steps are there in the Middle East. I guess one of them is what or how Israel will respond to the missile attack on Israel, as well as, I guess, a potential attack on Netanyahu's home. Where are we in that discussion?
Well, you're quite right. This is a multi-front war now, with multiple active fronts, with Israeli troops fighting in Gaza for over a year, now fighting on the ground in southern Lebanon, as well as continuing airstrikes north to the Dahia neighborhood of Beirut, which is the Hezbollah stronghold. We are still seeing missiles fired from Iraq, from Yemen, from around the region, and we are waiting to see what will be the Israeli response to the second massive Iranian missile barrage on Israel. We also, as you know, there was a recent leak of potential Israeli target plans that was leaked from the United States. I believe there's now a secret meeting going on, or a top secret meeting going on in Congress to discuss what happened and try to identify the source that seems to have leaked to the Telegram social media app Israeli plans that were shared with the United States. And it's possible that that source has more documents that may come to light as well. So that may throw a wrench in Israeli plans if the plans that were leaked are accurate. It's all unclear. As has been the case throughout this war. The only things that seem to be well known are that Israel intends to strike back at Iran, and that there has been a tremendous amount of coordination and discussion with the United States, given the sensitivity of our electoral calendar, with our election coming up in just over 2 weeks.
Well, as you mentioned, we do have a presidential election in just a matter of weeks, and the U.S. is hopeful for a ceasefire before then. And it's been reported that the Secretary of State, Antony Blinken, is set to visit Israel, among other countries in the area, starting today. And this will be his 11th visit in the region since last October. Can you speak a bit more about how the U.S. is playing a role?
Blinken is headed there. Amos Hochstein, the president's special envoy, who has been back and forth between Lebanon, Israel, and Washington for months, is there again this week. They're making every effort to, I think, at least keep it from spiraling further out of control. And to try and manage Israel's responses in line with U.S. interests. But they certainly cannot control events. As we've seen, events there, are beyond anyone's control, and even include surprises such as the killing of Hamas leader Yahya Sinwar less than a week ago, who was killed by Israeli regular infantry troops who did not know that it was him. And this is a massively important event which may eventually help turn the course of the war. I do not expect a ceasefire before the U.S. election. There is just simply too much going on. It's too escalated of a conflict at the moment. As you said, we are waiting for Israel's response to the Iranian attack. It is possible, not unthinkable, that Israel would delay until after the U.S. election, but I would say that seems less likely. And once Israel responds, then there will be an Iranian response. So a ceasefire, a total ceasefire on all the fronts is not in evidence. And I think probably the Biden administration is aware of that and is making every effort to keep this from, again, spiraling out of control or escalating in a way that is contrary to U.S. interests.
Right.
The U.S. has set up a special air defense battery, the THAAD missile battery, which Secretary of Defense Austin has announced is now on the ground in Israel. He didn't say whether it's operational, but obviously that's the plan, and I assume that it will be shortly. And that's to help defend against further Iranian missile attacks.
What are the end games for Israel now? Just in a year, it's gone from the initial strategy of neutralize Hamas and get the hostages back to I don't know what it is now. Have they articulated what their end game is here on this much broader front? Well,
I think there are two levels to this. So one is the Israeli defense establishment, the state, the broader strategy, and one is the Prime Minister Netanyahu, who has his own political interests, which may well be guiding some of his decisions and often put him at odds with his own defense establishment. I think that in terms of the broader Israeli interest, I think that right now Israel has been on the offensive after many months when it seemed that victory was, a ridiculous idea and that things were not going well from an Israeli military point of view. Israel has been on the offensive. It's dealt severe blows to Hezbollah and to Hamas. And it has, with help from the United States and regional allies, absorbed two massive Iranian attacks. Israel has killed, the leaders of Hamas and Hezbollah. So this has actually been, from an Israeli military point of view, the most productive period of the war. And I think that a goal is really to damage Hezbollah and Hamas as much as possible before the U.S. election. I do think that they're sensitive to our electoral calendar, and looking at that and thinking that after that election, they may need to recalibrate. So they're trying to get all the blows in they can before that.
Exactly. All right, Ned, thank you so much for joining us. Ned Lazarus, Associate Professor of International Affairs at George Washington University, giving us the latest out of the Middle East, a broadening conflict that we've witnessed over the past 12 months. Looking at the markets, red on the screen, the S&P off 21 points, the Dow off 220 points, and the NASDAQ off 50 points. That's 0.3%. We'll have more coming up. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, Norma Linda sitting in for Alex Steele. I'm Paul Sweeney. We're live here on our Bloomberg Interactive Broker Studio. We're streaming live on YouTube as well. Great Bloomberg opinion column piece out today by Mr. Tim O'Brien. Trump goes all in on Discord. Will voters follow him? Fascinating question. Tim O'Brien joins us, senior executive editor, Bloomberg Opinion, joins us here in our Bloomberg Interactive Broker Studio. The world knows what former President Donald Trump is. He is not going to change for anyone. Will he have the same support that he had over the past several cycles, i.e., 75 million people voting for him? He can count on that, can he?
I think he probably can. I mean, I think, the issue from the beginning has always been that middle swath. I'm saying nothing original here, but independent and moderate voters in the swing states are going to decide who the next president is, I think.
I mean, when we think about Trump supporters, what differences have you seen in terms of those who were rallying behind him in this campaign versus previously? Have you seen more of an influx of individuals that are coming in?
Where really struck me was when I was at the RNC in Milwaukee, and Trump's base hates the media, they hate critics, and it's generally a pretty hostile environment. I've been to other Trump rallies and events. And at the RNC, there was much less of that. They were riding very high at the time because they had arrived. They were no longer the outsiders storming the gates. They they have acquired power and are fairly certain how they want to now use it. And so I think there's more a sense of arrival and certainty among his supporters about what they'll do with the mandate he has given them. And I think that, in my perspective, that's a dangerous thing, because I think it's a profoundly anti-democratic and intolerant movement.
What's happened to the GOP, the Republican Party that my father grew up with since World War II, and that I grew up with? Is that gone forever?
Yeah, I grew up in the Midwest around traditional Republicans, and traditional defined by, I think people who believed in judicial restraint, robust national security, fiscal probity, et cetera, et cetera. And I think those are all wonky bread and butter policy issues that have been replaced by movement, culture issues defined around gender, race, I think avoidance and engagement with the outside world beyond the borders of the United States, and paranoia about the other. And it's proven to be a very effective path to power, so I think it's going to be with us for some time.
I mean, can you speak to what aspects of what Trump stands for speaks to certain pockets of the Republican community, whether that be the affluent and finances?
Well, I mean, I think there are, within both parties, there are multifaceted members of both parties. I think for working class Republicans, Trump is a guardian against demographic and economic changes that they feel threatens their well-being and their standing in the world, socially and economically. I think for affluent Republicans, there's always been this idea that taxes wind up being pickpocketing more than anything else, because they don't need the help from the government that other members of society do. You can have a debate around the virtues of that argument, but I think that's where they stand. And to a certain extent, I think they're willing to digest anything Trump says or does, as long as he does that for them.
So there is some concern there of, I think, some note out there in society that if former President Trump were to win again in this November, how he'll perform, how he'll behave once in office. And there are some concerns and fears about that behavior. How do you think that is as a risk, perhaps?
Well, I mean, I've never believed that Donald Trump is a strategist. I think it's a mistake to have the word strategy in the same sentence as his name. But I think that he is a profoundly emotional and is frankly sensationalistic man, and he prides himself in that kind of emotional connection with his voters. And he's clearly been on a revenge tour. You don't have to be particularly insightful to know what he's planning on doing. He wants to weaponize the Department of Justice and the military against perceived enemies, American citizens, and critics. That is against the Constitution and is against the standards we've all lived with. I think he is intent on doing that. I think he wants to withdraw the U.S. from the world, whether that's in East Asia, in the Middle East, or in Eastern Europe. And I think that poses threats for national security.
Have you noticed any differences in terms of tolerance in this election as we think about the controversy that comes out of rhetoric from Trump? Have you noticed that people have become a bit more tolerant of some of the controversial things that he says than they may have been before?
You know what I think is that this has always been with us. This is a country that was founded in a revolution. We fought a civil war to preserve the unity of the country. We have had all sorts of historical grotesqueries against indigenous peoples, slaves, women, et cetera, and have tried to work those out. It's one of the strengths of the United States, is that we've tried to work through those differences. Few countries globally have been able to. But I think all of the animosities and ugly thoughts that attend to those moments have always been with us. And I think the difference in the Trump moment is it's been made transparent by social media, and he's made it okay for us to entertain the worst angels of our nature. And I think that he's challenging us to really examine what the United States is about and where we want to take it.
Tim, thanks so much for joining us. Really appreciate it. Tim O'Brien, he's a senior executive editor for Bloomberg Opinion. He's got a wonderful piece out on the Bloomberg terminal today. You can also get it at Bloomberg.com. That's out there as well. As we approach, I guess, 15 days to the election. So for some of us, it can't come too soon. I kind of like these shorter periods. It's kind of like a European snap.
The last race.
Yeah, kind of pretty interesting. All right, looking at these markets here, a little bit of red on the screen, not going to oversell it here. We're going to get into the teeth of earnings later this week. S&P 500 We're off about 20 points. That's 0.3%. NASDAQ off about 40 points. That's 0.2%. So we're looking at the 10-year Treasury, 4.15% on your 10-year U.S. government bond. Gold higher. WTI crude oil higher at $70 a barrel. We'll have more coming up. This is Bloomberg. Good morning.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up in this hour, we're going to check in on the markets with Abigail Doolittle. She'll tell us what's going up and down there. George Ferguson's going to join us here. He's Bloomberg's aerospace analyst. I think we have a deal between Boeing and their workers out in the Pacific Northwest. We're going to get a vote on that in just a couple of days, going right down to the wire there. But it appears that there is a deal there. Ann Berry, she is the founder and managing partner at Threadneedle. She's going to help us understand what's going on in these markets here, and that's all coming up in this hour. Right now, let's kick it off like we do in the 11 o'clock hour with Mr. Charlie Pellet.
All right, I thank you very much, and here's what's going on. Stocks lower across the board. This Bloomberg Business Flash is brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with a 2-to-1 advisor-to-staff ratio, small firm attentiveness, big advisor impact. Go to commonwealth.com to learn about our consultative support and technology. The Dow, the S&P, NASDAQ, they're all in the red right now. 21-point drop on the S&P, close to morning lows at 58.42, retreating from last week's records, down now by about 0.4%. We've got the Dow down 237, a decline there of 0.6%, while NASDAQ is down 41, a drop there of 0.2%. 10-year 4.15%, the 2-year 4.02%. Gold up $3.50 the ounce, 27.25, up by about 0.1%. And West Texas Intermediate crude almost $70 a barrel, 69.89 right now, up by 1%. Markets and the election. We've got just over 2 weeks to go until the November vote. Callie Cox is chief market strategist at Ritholtz Wealth Management, and she was a guest this morning on Bloomberg Surveillance.
We remind our clients who are more long-term that, it's one person can't control the $57 trillion stock market. Maybe Jay Powell, but I'm not even going to go there for him. Trying to buy or sell stocks, depending on who's taking office, is usually a fool's errand.
Callie Cox of Ritholtz Wealth. We've got stocks lower. Boeing shares, though, higher, up 3.4%. Boeing and the union, representing 33,000 striking members, did hammer out a tentative new accord that notches up pay by 35% over 4 years. It is an unprecedented wage increase. Boeing shares, again, up today by 3.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Norma Linda sitting in for Alex Steele. I'm Paul Sweeney, and we are live here in our Bloomberg Interactive Broker Studio. We're streaming live the video thing on YouTube, so head over to youtube.com, search Bloomberg Podcast, Bloomberg Live Radio. Either one of those things will get you where you need to go here. Looking at these markets, as Charlie was just reporting, got a sell-off here, kind of plumbing some of the lows of the day, it seems like, across some of the major indexes. Let's see what's happening under the hood. To do that with Abigail Doolittle, Chief Markets Correspondent for Bloomberg News. She joins us here in our New York City studio. Abigail, what are you looking at?
I'm looking at that decline that Charlie was just talking about, down 0.5%. The volume's pretty light for the NASDAQ 100, just a little bit less. Where there's bigger declines, that Russell 2000 down 1.4.
Yeah.
Yeah, 1.4%. And there is the head of equity derivatives from Cantor Fitzgerald joined open interest earlier today. And along with another guest on open interest, really talking about the Russell 2000. It's basically gone nowhere over the last 3 years. Cantor Fitzgerald saying that there could be a nice pop into the end of the year. That's not happening today. Now, beneath the hood for the S&P 500, Kenvue, the best gainer from a percentage standpoint, up 6.8%. We have some news there. Right below it, we have, of course, Boeing up 3.6%. But on Kenvue, of course, that's the spin out from J&J. There's a Starboard activist stake. The Wall Street Journal reporting it's a quote unquote sizable stake, but we don't know exactly how big it is. But they're, of course, known for going in and improving things. So the maker of Tylenol and so investors liking that possibility. Boeing up 3.6% on that tentative strike being off.
Yeah.
They agreed to a 35% raise over 4 years, among a few other factors. You know, what really strikes me there for Boeing is this is Kelly Ortberg's debut, essentially. Last week when he played hardball with them a little bit in terms of firing 17,000 people, and George Ferguson, at least per my understanding of speaking with him, thought that there could be some union peoples in there, so a shot across the bow, like, listen, you got to come to the table or your job might be at stake, and it seems they came to the table.
Right, and earnings this week, right?
Yes, earnings this week.
Wednesday before the close, I think. Before the open.
Yeah, and so we'll be able to put more of a voice to Kelly Ortberg. Right now, this is action. And, you know, it's interesting because, like, the whole thing, walk the walk, talk the talk. He's been walking the walk. Now we're going to hear him talk the talk. Usually it's backwards. So he seems to be starting from a position of strength. And you both know that I like a good chart. Boeing's chart's interesting. It's hanging on by a thread to hold support. It seems as though if this strike is off, if this deal is approved and earnings, you know, the numbers are relatively decent. They already pre-announced it. We know that they were, and that most of them unaffected by the strike. There's reason to think that that support may hold. It doesn't mean the stock's going to rally in a big way, but it does suggest that it's less likely to keep going down.
So what's going on with airlines? I know you're keeping an eye there as well. I was keeping an eye on Spirit Airlines. I know that they got some sort of extension when it comes to refinancing its 2025 bonds.
Yeah, so that stock up, wow, right now it's up 54%. I should mention, though, it's a $2 stock, well, $2.26 stock right now. So I'm looking at, so that's the best day probably ever since going back to 2011. Now let's take a quick look at the short interest to see if that's a factor. I'm guessing it is. Yeah, so there's a 33% short interest. So yeah, basically they have a lifeline. Their going concern continues right now in terms of actually staying around. Other airlines, though, such as American Airlines, I'm pulling up right now, down 1.7%. Delta Airlines down 1.7% as well. And then I'm going to pull up Southwest Airlines here. That stock down 2.4%. What makes that interesting is last I saw, Southwest is seeking to create some sort of a quote-unquote truce with Elliott after some major policy tweaks. I think that the big pressure on airlines today could just be rising oil. It's that inverse relationship. Right now, oil up about 1%, earlier up more than 2%. I think that could be a piece of it.
All right, good stuff. Lots to cover out there, and we've got a big, busy earnings week this week. I think 20% of the S&P 500 reporting. Abigail Doodle, thanks so much for joining us. Abigail Doodle, she's the chief markets correspondent for Bloomberg News, joining us live here in our Bloomberg Interactive Broker studio. One of the names Abigail was talking to us about was Boeing. And we want to figure out, are these folks going to be getting back to work? Because they need planes to come off the line. They need the cash flow. They need to get folks back to work. George Ferguson covers all of the aerospace, all of the defense, and all of the airlines for Bloomberg Intelligence. So, George, it seems like the union's representatives have agreed to a deal with Boeing. What do you think the actual workers are going to do when they vote?
So I think we're getting closer. Look, I think 35% is the increase over 4 years. It's still, I think, sub some of the other union agreements we've seen in the marketplace. Like the port workers. But I would note that Textron had a similar strike by its machinists out in Wichita, Kansas. I'm not sure if you get through there very often, Paul, we're aware of that, but they just came back they agreed to come back to work. It was kind of a sub 30% increase over 4 years. So my guess is, the shore workers probably, or the port workers probably set the high end of the mark. These Wichita machinists for Textron probably set the lower end. Boeing probably lives somewhere in the middle. The 35 sounds about right. Workers have been out on strike for about a month now, right? So my guess is that finances are probably starting to look challenged at some of those households. I think Kelly Ortberg, pulled out hey, we're going to raise $25 billion in cash and we're ready to go the distance. So I think those combinations, and then throwing some of the 401k money at them, right? There was some plus-ups on how much they would match in 401k. I think some initial, incentives on the 401k. I think they're pretty close, although I note that the union leadership wouldn't endorse it from everything I've read. They're just passing along this offer from Boeing to the workers, for a vote. My guess is this is pretty close. I think they might make it here, but I guess we'll get a chance to see by Wednesday, how cranky the union is and how much more they want. But it seems like it's pretty close.
George, how important is an end to this strike for Boeing and just broader sentiment there? I mean, shares are down about 39% year to date.
Yeah, it's huge, right? I think if it doesn't get agreed to, I think Boeing almost needs to raise money anyways. I guess it might help them decide what amount of cash they need to raise. I'm hearing stories that the supply chain's still building at the rates prior to the strike. Components are stacking up on their, on their loading docks. I think the longer it goes, the harder it is to restart the line, the longer it takes to restart the line, and the longer it takes to generate cash. And I think Kelly Ortberg would prefer not to go to the equity markets for a lot of money and prefer not to have to draw down any additional debt, not that they've said they would do that at this point. So it's very important for the turnaround. And again, timing is crucial to keeping the supply chain, I think, healthy and ready to go.
George, talk to us about, I know in the past you've educated us about the cash and how the cash comes in and cash leaves a company like Boeing, and it's tied pretty tightly to those 737 jets leaving the floor. How quickly can they restart it, and where do you think the build modes for that 737 jet will be, and where do they need to be?
Yeah, so I mean, they need to get that jet up into the mid 40s and 50s. I think it's going to take them, I think even if the strike ended today, I think they're not going to hit sort of, the 40-ish. Their target was 38 by the year end. I don't think they're going to hit maybe a 40-ish level until mid-year next year. They ought to be driving up towards 50. Maybe hopefully by the end of next year if the strike ended relatively soon. By comparison, Airbus's competitor airplane, the A320, that's being built right now in the mid-40s. They're driving higher into the they hope to be driving higher into the mid-60s, I think, over the next year or so. It hasn't gone as well for them as they'd like, but their competitor product is doing much better. That is the cash cow for the company. Defense is really, back on its heels right now because of some of these big fixed price contracts they signed that are out of water, which makes it that much more important to get the 737 rolling off lines. And just, I think, an interesting point of comparison, if you look at Boeing's inventory level, last time we saw it at 2Q, $85 billion of inventory on their balance sheet. Their competitor Airbus was in the mid-40 level billion dollars. So you could tell that's just an example of how bloated that inventory level is and how much they can unlock as they start to deliver airplanes. But again, 737 is the key to that. And they want to keep market share in that airplane too.
Speaking of market share, I did want to get your take on how investors are thinking about Boeing. I mean, of course, it's had a really troubled year when we think about 2024, but as you mentioned, they have Airbus as a competitor, but not too many competitors out there. So how do investors think about this when they're thinking about Boeing and its longevity?
I think some of what you've seen today in the stock price gives you a sense. Investors know it's a duopoly. And look, we've been doing some work recently on the backlogs. And if you looked at Airbus's backlog for the competing airplane, the A320 I was just talking about, competing to the 737,